Alright, so in this video, we'll cover how to read raw price action. Once again, price action is the best way to trade, and we need to know how to read it and understand it correctly depending on how price presents to us on a day-to-day basis. Price action can allow us to not only make money consistently, but it can allow us to do so in a way that most traders cannot, right? Most traders typically trade using indicators, Fibonacci, EMAs, a whole array of vastly different techniques. However, those things always lag behind price. Now, because raw price action movement happens minute by minute, candlestick by candlestick, as we learn to read it correctly and objectively, this allows us to always stay one step ahead of the market and then, of course, make money in the process. So let's go ahead and jump in and learn how to do it correctly. All right, so reading raw price action is probably one of the most instrumental things you need to know how to do to trade in the ways that I will be teaching you guys over the duration of this course. So I'm going to start from the weekly time frame, drop down to my daily, and then drop down to my H4, and last but not least, my H1, and just cover how to read raw price action based on how candlesticks are formed so we can understand certain things when it comes to trading. All right, so starting from this point here, as you can see, price was flowing down. We stopped on the dime. We created a floor. All right, floor, support, those words I will be using synonymously to represent the very same thing. All right, but for the sake of this video, just continue to flow along with me and understand whenever I say a floor, I'm referencing support, or if I say ceiling, I'm representing resistance. All right, so price found this floor, we impulsed up, we came back down, and we rejected off of this same floor. We pushed back up high again, we rejected off of this ceiling. Now, for those guys who remember those basics, we had 1, 2, 3 rejections to the high side, giving us a triple top rejection. And then, of course, you can see that price dropped to the downside. We came close to our previous floor. We pushed back up very slightly, and then we came back down to that next second floor that was created after this one. Now, of course, if you take a look at it, you can see we had a bullish candle that pushed up, followed by a bearish candle that pushed down. This now gave us a double top. This now gave us a double bottom. All right. The minute you have a double top or a double bottom back to back in the same area, that is indicative of price trading sideways. That is also known as consolidation. Another word for consolidation is actually accumulation. All right. In the glossary of terms, you guys will have seen that. And so, of course, coming back into reading raw price action, once again, the minute I get a double top and a double bottom, that lets me know that I am trading inside of a range of consolidation. All right. Now, notice over the next upcoming weeks, we pushed outside of that range. We came up and we produced a high relative to the previous area we were in the market. Right. Notice how price then flows down. Once again, it forms a floor. We attempt to go on up. Right. However, we ultimately failed to give us a new rally to the upside. We, in fact, break down and we break through that floor. All right. So when we're reading raw price action, once again, it is the creation of demand, right, which represents bullish buyers, upwards movement. It is the creation of demand that will cause the market to turn and go up. It is the creation of supply. Once again, resistance, sellers, price pushing downwards that causes price to go down. All right. So you can see in this particular fashion, we drop down, we attempt to go bullish, and then we continue dropping down the following week. You can see that we found the floor here again and still ultimately pushed to the downside where demand was formed, and as a result, we had a following candle that pushed us up bullish. All right, so learn to read raw price action. You can see that we dropped down for a week, we pushed up for the following week, we dropped down the following week after that. Next week we went bullish, next week we went bearish. We found the floor, we found some demand, and then we pushed up to the high. right? Notice once again how we stopped at this level of resistance. The level of resistance, the supply that caused price to turn around and go bearish, go down after it attempted to go up. All right, we rejected from there, we attempt to go down. Notice how we attempt to get back down to this area of demand. Now remember once again what I said about the wicks. They represent trading activity. And so over the course of that week, you can see that trading activity took us all the way down here to the low part of where demand, or where this floor was created, before impulsing higher. All right, upon getting higher, you can see that we got slightly higher than the previous high that we just created. And then from there, you can see that we came into some supply. And once again, how do we know came into supply? Because price created a bearish candle, right? And we dropped down the next 2 following weeks, right? For those of you guys who remember your patterns, you can see that we came back on up into this area of supply, this resistance, this ceiling, and then we had a nice engulfing and we dropped to the downside yet again. All right, one more push on up. You guys can start to see now what the market likes to do: create double bottoms, create double tops. It likes to revisit areas of supply or demand. You can see that it turned around and dropped and went bearish 1, 2, 3 weeks before once again finding a floor, an area of demand, and impulsing to the upside before once again pulling back and then continuing higher. All right, so continuing on, pull back. You can see we have rejections. You can see we have trading activity all the way on up to this level. However, price always closed further back down here. All right, we had a bearish candle followed by a bullish candle that took us back up into these highs of trading activity before ultimately rotating us on back down to the previous level, the previous floor that was created. All right, so as you guys learn to read raw price action, right, one of the key things you guys should keep in mind is going to be what I like to call my impulses, right, and my swing highs or my swing lows, and of course learning how to read raw price action based on how candlesticks are formed, how to understand when you're getting consolidation or when you're getting a trending move. So let's go ahead and switch to our daily time frame and let's take a look at some of these very same things. All right, so my daily time frame, you can start to see I have more candlesticks, I have more definition in terms of what the market was doing. All right, so let's go ahead and highlight a couple of things for you. Number one, let's pick out some consolidation. Consolidation. All right, a range of consolidation inside consolidation, and another range of consolidation even inside that area of consolidation. All right, more consolidation. And as you guys starting to see by now, the market does consolidate quite heavily when it comes to market movement. All right, you can consolidate in one area of price before you get an impulse, and you can get a new impulse and then turn around and consolidate again. Right? Typically for me, the minute I see a double bottom and a double top back to back, that lets me know I am now trading sideways. And until I break out of that range of consolidation, the most accurate, the most best way for me to possibly trade is going to be trading the very tops of that range or the very bottom of that range of consolidation. All right. Now let's talk about my impulse moves, my swing highs, and my swing lows. So when it comes to my impulse moves, my swing highs and my swing lows, all right, I like to always make note of the areas on my chart where after having an impulse, price turned around and pushed down, as opposed to price just simply going sideways. All right, so first and foremost, let's just make a quick edit and let's switch to a solid line and make this a little bit bolder. All right, so let's take a notice here. Notice how after a nice push down, we turn around, we impulse higher, right, from this area where price moved down from. Notice how we have a very small pullback before a continuation upwards in price. And then notice how we have a more dramatic pullback, a steeper pullback that took us much further down in price. All right, once again, notice how we push up. Notice how we swing back low. All right, once again, we push up. Notice how we swing back low. You can see that we can have these swing lows that then produce new swing highs, right? And in the course of that swing low and swing high movement, you can see we have areas that don't really produce any pullbacks, all right? They don't really produce a nice swing low as opposed to some of these other areas on the charts that we just identified. All right, so your swing lows and your swing highs. So in this case, covering swing lows as price makes its way on up. These are going to represent some of the stronger areas in the market that can produce bullish movement, bullish activity. All right. Same thing can be said for swing highs, right? Which are typically formed in a downtrend, right? What we'll get into just a little bit later. So your swing highs and your swing low, your impulse moves. Right, your impulse moves specifically just speak towards the areas on the chart where upon price retesting or revisiting them, it took us on up to a new high or produced a strong bullish move. So for example, notice here after price produced a swing low, right, we had a impulse move in the market that took us on up to a new high relative to the previous highs we were just currently trading at. All right, and you can see upon retesting that impulse area, we turn around and we produced a new high again, similar to what this impulse area did relative to this area of price action. All right, so once again, your impulse moves, right? 9 times out of 10, they're going to produce some kind of new high in the case of an upward trending market, or produce a new low in the case of a downwards trending market. And those impulse moves gives us a nice significance when it comes to understanding where nice, strong, bullish activity can possibly be had, therefore giving us those nice buy trades to catch anywhere from 50, 80, couple hundred pips, or possibly swing moves for a couple hundred pips, depending on what currency pair you're trading on. All right, so now let's take a look at the opposite when it comes to those swing highs. All right, once again, typically formed when market is trending downwards. All right, so let's go ahead and highlight a couple. All right, moving on, you can see that after price created a nice downward push to the upside, we had a nice pullback, right? Pullback simply meaning, once again, price pushed back opposite of the way it came. So we pulled back 1, 2, 3 daily candles. You can see that supply was formed. We had creation of a ceiling, right? Also known as resistance, and then we impulse lower. Right, you can see that these 1, 2, 3, 4 candles took us lower than the low we previously sustained in the market. And you can see price came back on up to retest that same supply area, right, before pushing lower. And you can see one last touch was had on that area before we turn around and we institutionalize a much bigger push to the downside. Right, now notice as we push to the downside, unlike the pullback, the swing high that was created, we simply just had price drop into a range of consolidation. All right. Consolidation, we fell out of it. You can see we had a very minor pullback again before continuing downwards. All right. You can see we found the floor, created some demand in the process. We created some demand in the process. We pulled back on up, right? Meaning we pulled back on up from the direction we were currently moving in, which was downwards, before pushing down. And then notice how this is formed, by the way. Bearish candle, bullish candle, bearish candle, bullish candle, bearish candle, right? This entire movement, as you guys can see, was simply price trading sideways, right? So it is very important to notice how price forms its price action. Not only were we trading sideways, we were maintaining this floor. We were maintaining the demand that price had created here in the process that led to its initial pullback. So your ability to pick up on the sideways movement the market's giving you And of course, being able to pick up on the trending movie the market's giving you makes all the difference when it comes to trading. Knowing whether or not you are getting the type of scenarios that require simply trading at the very bottom or the tops of the range to get good trading pips, good trading activity. And of course, whether or not price is getting ready to continue your downwards bearish move. All right. So reading raw price action, you can see that we had an attempt to break out of consolidation and we failed. Now, how do we know we failed? Because quite simply, price pushed back on up to the highs of the range. All right. You can see we had an attempt to break out again. However, we stopped, and in the process, we pushed back up to the highs of the range. One last time, you can see we attempted to break out again. Right. We had a slight pullback on this daily candle, followed by continuation outside the range finally. Now note that we came into this range around the 28th, all right, and the 1st of December, November going into December. And notice how we finally fell out of that range almost a whole month later, December 23rd. That is one of the key things to note about ranges of consolidation. Sometimes price may enter them and stay in their range of consolidation an entire month. All right. And so that's why it's important to always know, once again, what raw price action is telling you in regards to market movements. When inside a range of consolidation, we will not be getting any type of swing trades or trending market type moves that we as traders love to take advantage of when it comes to catching pips and making profits. All right. So your ability to read raw price action allows you to switch up on your market approach objectively, right? Knowing when to intraday trade, knowing when to swing trade, or possibly knowing when to just scalp some pips based off of the opportunity that the market is giving you. All right. Continuing on with this quick reading of raw price action, downwards movement, price pulls back, continues higher, we push back down. We attempt to go up, indicated by the trading activity visible by the wicks. We failed to do so. We push to a new low. We come all the way back on up to the highs of this trading activity, right, where resistance, ceiling, supply can be found before we push back down to retest that low. Upon retesting the low, the demand that was created here, you can see that we impulse higher, right? Very minor pullback, right? Not a big dramatic one, before we continue higher. Once again, very minor pullback before we continue higher. Very minor pullback, retesting demand, this floor as it was created before we continue higher. All right, before last but not least, you can see we made our way all the way back on up to an area of supply in the market that produced this huge bearish impulse. All right, so as you can take note of this market movement, you can see that price will like to move from impulse area, sometimes right back up to a previous impulse area or as close to it as it can possibly get, before then turning around and continuing that bearish push. All right, that's one of the key things to note about price action. Now, this area is a good understanding of how price will create consolidation and sometimes turn around and expand itself inside that range of consolidation. So initially, we had 1-2 candles, all right, giving us indication of some sideways movement. And then from there, price impulsed higher, all right. Trading activity for that day took us all the way up here. However, we closed down here as far as the daily candle is concerned. And then from there, we went on trading sideways inside of this range, right? Once again, consolidation can have smaller pockets of consolidation inside the same range. However, when trading, the best way to trade consolidation, because we understand raw price action, is going to be on the very outside edges, right? When you're trading inside the middle, the range of consolidation, things can get a little tricky. All right. So coming back into the basics of raw price action, we're going to leave this area. All right. And once again, I just want to make a quick mental note. We have small pullbacks followed by these huge pullbacks. All right. Small pullbacks followed by big ones. We have areas of consolidation. We have our impulse areas, right? areas that produce huge impulses up, and upon price coming back down to retest them, they produce another huge impulse, potentially sometimes giving us a higher high in regards to the previous high that was created. All right. Of course, you guys remember we have our swing highs, right, leading into more downward movement. We have our swing lows that leads into more upwards movement. So now let's go ahead and take a look at this on the H4 chart. All right, so I'm going to start from this area up here on the H4 chart, and we're going to continue on. So once again, preceding this peak up here, you can see that we had a pullback that then led to a high. You can see we had a creation of supply, creation of a ceiling. You can see we had a bearish candle followed by a bullish candle followed by a bearish candle, letting us know that we had an area of consolidation. You can see we broke outside this area of consolidation and we moved downwards, right? Bullish candle, bearish candle. We continue following down, followed by a bullish, bearish candle. You can see we rejected at support once and twice for a double bottom. Shot up to retest highs. You can see that this indicates the highs of trading activity. The candle closed down here. You can see we attempt to go on up. Once again, we failed to do so. The candle closed back down here. You can see that we moved downwards over the next course of the next 4 hours. All right, so 1, 2, 3, giving a total of 12 hours of bearish activity. All right, before turning around and going back on to the high. All right, now notice once again, like I said, whenever I have a double bottom and a double top, that lets me know that I'm trading inside a range of consolidation. All right, meaning price is not actively trending to the upside or not actively trending to the downside. And it's only after price breaks and leaves that area of consolidation, I know how to objectively move forward with my price action candlestick analysis. Notice after this huge drop, we push back on up, and then we have once again consolidation, right? We have 1, 2, 3, 4 multiple rejections to the upside, along with 1, 2, 3, right? Multiple rejections to the downside. Remember, once again, the creation of supply, right, institutionalizes my ceiling. The creation of demand institutionalizes my floor. And therefore, when I see price hit a floor, right, after going bearish for that hour and goes back bullish, right, with my color scheme being black and yellow, this lets me know that there is a floor here. And as long as price continues to reject off my floor, this lets me know that price is maintaining itself, right, from going south. And if I see price maintaining a ceiling, this lets me know this is price maintaining itself from going north, right, going upwards, right? Therefore, as I bounce back and forth inside a range, I know that I am in consolidation, potentially waiting a breakout to either side to let me know which way price is going to tending to go. And of course, I know that the best possible way to trade inside a consolidation market is going to be the very tops and the very bottoms. All right. Now you're probably looking to yourself and thinking, wow, price always consolidates. And yes, that is true. In fact, the forex market spends about 70% of its time consolidating on a day-to-day, week-to-week, month-to-month basis, right? Only 30% of the time we are in the trending market. Now, the beauty of what I teach you guys and how to read raw price action allows you to trade on a day-to-day, week-to-week basis, catch moves, catch pips, make money, no matter what type of market environment you're in, whether or not you are constantly trending upwards or downwards, or whether or not you're in a consolidating market. Supply and demand and raw price action are the two key important things that allow you to trade accurately and consistently and make money every time you sit down to your desk. Okay, so in this video, we're going to talk about support and resistance. Now, support and resistance are very basic, but yet key important concepts to understand and master when it comes to trading. So in this video, we'll take a deeper look at how to draw them correctly, how to understand their importance as it relates to price action, and then Further on in the course, we'll learn how to use them in corporation with a particular subject I call transition. Let's go ahead and get started. All right, so support resistance are one of some of the most basic terminology, but yet some of the most important things that we use when it comes to understanding the markets. All right, so support, let's talk about how we draw it. Support, also what I mean when I say a floor, right, can simply be drawn by using a line. All right, so once again, when we cover how to use TradingView, I favor the tools that I use most often when it comes to my analysis on my charts. All right, and of course, this trend line option being the main one. This allows me to draw a line for me to highlight support on my chart. All right, once again, representing a floor. And of course, this allows me to highlight another line, draw another line on my chart that I'm going to use as representation of resistance. All right, so starting off now on our daily time frame, first and foremost, let's just take a couple of practice examples of drawing support and of course drawing resistance. All right, support and of course drawing resistance. All right, so the key thing to note here, right, I simply just drew major support and major resistance that pretty much capitalizes this entire area of price action. However, if I were to move our drawing tools and also flow with this in a very linear sense, and let's move back to how price is moving, understand that support and resistance get formed very often in the markets, right? Same as supply and demand. However, similar to supply and demand, support and resistance can get broken and then therefore no longer be relative to what price is currently trying to do. So for example, starting from this area in price, you can see that we had a level of support, and as we continue pushing higher and higher and higher, we create a level of support here as well, also creating an area of demand. All right, so when it comes to drawing support and understanding support, typically for me, from a very visual perspective, I usually put it right underneath my candle body, as you guys can see here. And of course, there is no 100% perfect way that it needs to be done. The basic rule of thumb, the basic understanding that we should want to have when it comes to drawing support and resistance is that we should just have simply right underneath our candle bodies. And from a visual perspective, like I said, we can leave a little bit of space in between. All right. Now, of course, when it comes to editing support, editing our zones, like we previously just saw, we want to drop down to a lower time frame. We want to make sure that we're mainly covering wicks and not candle bodies as we move from time frame to time frame. That is something we will revisit later on as we get more advanced into trading, and of course, adding in trend structure. We look at time frame correlation, etc. So coming back to these basics of support and resistance, you can see that support was created as price continues pushing higher. And then from there, you can see that as price turn around and drop through, we broke through support in not only one area, right? We broke through it in the second area, and we broke through it in the third area, right? And of course, we kept on impulsing lower. You can see we paused here, but still ultimately broke through this floor, this level of support as well, right? Now, when price is moving heavily in a downwards fashion, tons of volume, tons of momentum, right? It's very common to see it break through floors as this makes its way on down, especially when we're getting to reverse our overall market direction. Just look at some basic understanding of support and resistance. Once again, support, and you see price retesting support. And of course, now you can see price creating support slightly higher. All right, notice how we did have a slight level of support here, but ultimately it was broken as price came on down. Therefore, we will simply delete that area, letting us know that price was no longer, or rather price could no longer maintain support here. And in fact, broke that support, came back down to this area before turning around and impulsing higher. All right, notice how we attempted to maintain support in this area again. We were successful and were able to push up to new highs. Right, similar to how we read supply and demand, we can read support, our floors, in a very similar fashion. Right, reading candlestick raw price action, we pushed up for a day, we attempt to go back bearish, we failed to do so. The fact that we see wicks here, and of course we see price push the opposite way, this lets us know where demand was formed in the market and where a floor was created. And then of course you can see where price broke that floor, came back up on the other side, rejected off of it, and came back on down. All right, so that's going to lead us into another topic when it comes to support and resistance. So when it comes to support, upon being broken, and when I say broken, I simply mean price says push through beyond it with typically one or more candles, which you can often very find the market do as we read raw price action is that it will retest the opposite side and then turn around and drop. This is what's known as a break and a retest, right? And of course, price following through to the downside after that initial breakout. Now, this process is what we call transition, and that's something we'll cover a little bit later. But to focus back in on support and resistance, once again, you can see the floor is broken. You can see price retests on the side and then it rejects. There's a retest on the opposite side. And of course, rejecting is how support can become resistance. All right. Now, once again, very common theme, a very common thing that happens in the markets, right? You will see broken support turn around and become resistance. However, one key important thing to note, which will also be in your text lesson below, is that support, when broken, does not immediately become resistance. We always need price rejecting after retesting that broken level of support and then turning around and falling away for us to confirm it as a broken level of support that then turned around and became resistance. So for example, let us take this area here, and you can see we're moving sideways for quite some time in a range of consolidation. You can see that after breaking that level of support, we were able to pull back and get beyond this broken level of support in the market, right? Once again, this support that was holding up price from falling any lower. And of course, you can see we have level of resistance that was holding down price from going up any farther. All right. You can see once again, after being broken, we came back above it, rejected, and then we came down. It was upon getting this 1, 2, 3 candle variation, could we properly confirm that this is now where resistance is in the markets. And then of course, that ceiling being what holds price from going beyond and going upwards any further. So once again, you can see a nice double top variation. Right, and then of course that leads to a decline in price. Right, and notice how we have some ceilings that were created in the process. We have some supply and demand that was also created in the process. And of course, after 1, 2, 3 rejections off of supply, right, you can see where our level of resistance was drawn. Price was able to ultimately rotate and push through the upside, therefore taking out this area of supply in the market and also breaking these ceilings as well. All right, so continuing on, you will see that upon pushing up, we create a level of support further down here. All right, and after price broke the level of support, you can see that we attempted to come back on up and retest on the opposite side. Once again, like I said, we'll often see price break supports, retest, and then continue pushing down. All right, however, once price has done so, you would then simply focus your ceiling, your level of resistance on this area here, rather than having it cut through candle bodies. Now, preferably, the way I always like to draw it is once again never cutting through candle bodies, similar to the way I draw my zones, and also more so focusing on this new era of interaction moving forward into the foreseeable future. All right. Notice how if we continue flowing along with price as it develops from each day to day to day, once again we are on a daily time frame, we can see that price created a floor down here, rejected it from off of it once after creating it, therefore giving us a double bottom. Once again, we had a ceiling because, well, hey, what's going to push price back on down if not a ceiling or level of resistance? And what's going to push price up if not a floor or also, as I like to call it, a level of support? So in this case, a ceiling was created and price came back on down. You can see then we were able to push through that ceiling. We came back to retest it on the opposite side and then continue that upwards push up until we stalled. You can see we had trading activity pushing up into these ranges. However, we failed to go any higher. And then from there, you can see we came back down and closed on and slightly beneath the level of support, one more retest to the upside of where supply had been created and formed, before finally breaking through that level of support that we would have had here in this particular area. All right, before finally making our way back on down to this area of support. Now, your support, your resistance, your supply and demand, they go hand in hand, right? At any level of resistance, supply can be found, and any level of demand, right, a support level can be found. So over the duration of this course, you will hear me say supply or resistance or ceiling interchangeably. Always pretty much I'm highlighting an area in the charts where price interacted with supply, ceiling, or resistance and made its way down, or an area in the charts where price had interaction that then led to a bullish move up, of course, representing where demand can be found on the charts. Typically for me, I color coordinate my supply and demand with blue or green, specifically speaking towards demand. And I like to color coordinate my supply with red or with orange, specifically speaking towards supply. All right. So once again, green and blue, red and orange, and now getting back into support. Now, as we flow with price action, once again, we will very often see where broken resistance will become support. Similar to what we have with supply and demand, we can have areas of support on our charts, and based off new interaction, we will then need to edit those areas. All right, edit that line. And of course, continue trading based off of our new interaction. All right, price will often create floors at different levels, or in some cases, even right away from a previous floor. And in some cases, we can see where price will interact with our level of resistance, get above it, however, still turn around and push to the downside. This is what's known as an overshoot of your resistance, right? Because price did not continue trading and pushing up higher. We still, in fact, rejected and continued to come back on down. We simply just rejected a little bit higher than our initial level of resistance. So once again, those are our overshoots. This is a actually key important term and something you guys will learn in deeper detail when it comes to understanding transition, right? The process of break, retesting, and follow through as we make our way into the course. So to wrap up our basics on support and resistance, right, we're going to drop down to a H4 time frame. We're going to understand that, well, despite different time frames showing you different array of candlesticks, different array of price based off of that particular time frame you're currently on, right, you can and you will see support or resistance look different based on the time frame you're on, right? However, because price knows no time, because we use different time frames interchangeably with each other, we know that while you may have a daily level of support, we can also have a H4 and a H1 level of support if you switch time frames. And of course, these support and resistance levels are all subject to the same rules. We can have a 1, 2, 3 rejection off of them. We can have an overshoot over our level and price still ultimately respects it and continues pushing higher. And of course, we can have a complete break of our level, a retest of it before price impulses and continues the downwards move following the initial break of our level of support or resistance. So to continue on with your Forex education, we're going to highlight support and resistance on multiple time frames just to get you guys used to seeing it, observing it, making note of it, and understanding how multiple time frames will show support or resistance in multiple different places. And in some cases, your same level of support or resistance on one time frame can also be the same level of support or resistance on another time frame. And this is because price works interchangeably with each other. Therefore, one time frame may paint the same picture as another, or one time frame may paint a slightly different picture than the other based on how those candlesticks were formed on that particular time frame. However, at the end of the day, all time frames both paint the same price direction, and of course it's up to us as traders to understand that and use that knowledge to the best of our ability. So I picked this little area on Euro USD, and we're going to start off on the M5 time frame. That's one of our minor time frames, and we're going to use the color blue to highlight all support levels as price made its way on up from here all the way up to here. All right, so let's go ahead and just delete the little arrow. We're going to click on our trend line selection, and let's drop down to our M5 time frame. All right, so to zoom back out, let's get to the bottom of the area. We're just going to simply highlight every time price created a level of support. And of course, whenever price did break that level of support, meaning we pushed through it, we're just going to simply delete it and then reapply a new level of support where price created it. All right, and we're just going to flow with price as it's made its way on up. And this is just to simply show that price can create support, right? Use it momentarily and then turn around and break it. That is the nature of price, to flow up or down, to break support or resistance, right? And we'll correlate that later on in the course with transition, and of course understanding how different time frames can do different things. All right, so starting first at the very bottom, you can see we have a level of support. We have another one here, another one there, and we had another one here. Now you can see price pushed through that area, and so simply breaking that level of support. However, you can see that we came right back on the opposite side. So in these scenarios, this is what we like to call a tested area of support, meaning price was able to close and break beneath it. However, we did not reject off of it and come back down to the opposite side. All right, so continuing on, you see we have support. We have support here again, and in this case you can see that we had a closure beneath it, right? Came back on the opposite side and then turn around and follow through right back on down, right? In the process, you can see almost like price was trying to halt itself, right, by rejecting and turning around, creating these minor levels of support. However, ultimately we were able to break on through till we came back on down to a previous level of support, and then from there turn around and impulse higher. So let's continue to flow with our price. All right, support being created and then retested and rejected, and now we're going higher. Once again, when price does stop and reject from an area, right, you can see that it is creating support in those areas as it intends to push up higher and higher and higher. But like I said at the start of the video, you can have areas where once again price breaks it, retest it on the opposite side. In this case right here, we broke, we retested, and we pushed straight on through. And then from there, we created a new level of support, and we continued pushing higher. All right, so I'm just moving these lines over, using them freely. All right, you can see we were able to get beneath this level of support that we have here. However, we did not retest on the opposite side and continue following down. We closed beneath it and then jump right back above it. We close back beneath it one more time, and then we continue flowing back above it. So flowing with our price, basic support. Let's just continue to highlight these. So you guys starting to see a familiar pattern of how we draw support, how we highlight it, how we can recognize it, and view it on our charts. All right, so multiple support levels on the M5 time frame. We deleted the ones that were broken through. We just kept on adding on new ones. And of course, now let's actually zoom up to a slightly higher time frame and see what that looks like. So let's go from M5 to M15. All right, and so we can see that some levels of support that were drawn are not accurate when on the M15 time frame. And that is because, once again, when you go from one time frame to the next, your candlesticks will look a little bit different. Your M15 candle will look slightly different from your M5 set of candles. Therefore, the support levels that's evident on that time frame can be different as well. So from an M15 perspective, we could simply edit that, and that'll be a better representation of our M15 support. We can edit this here, show a better representation of this M15 support. You can see we had one here, but of course price kind of closed beneath it and then turn around and shot back above it. You can see that this is not a level of support because these are all bullish candles. Therefore, price did not reject here and then turn back and go back around, as we can see here. All right, so support, all right, support again, all right, support again. You can see we closed beneath it, retested it, came back down, rejected off of this area, and then pushed back on up higher. All right, so of course, minor supports created based off the rejection and then a continuation after rejecting it. And once again, another one here, not a valid level of support, although it was on the M5 time frame. Let's take a look at this area here. This needs to be edited. This should be level of support. That's better suited for the M15 time frame. And then from there, of course, similar to an M5, we saw that break. We saw price trail on downwards before continuing up. All right, so if we continue up just a little bit higher with this, just drawing our supports as they're given to us on the M15 time frame. Once again, just a simple little demonstration, a simple little method and exercise to help us understand support can be created, right, and then broken in some cases. And of course, support can be different when viewed on various time frames. All right, so I've highlighted just a couple of support on M15, continuing up this bullish push, this upwards move that we had. Now let's zoom out to our next relative time frame on M30 and let's see how that looks. So on M30, you can see that some of those levels we had highlighted on M15 are not the same. These are all bullish candles. We did not have a bearish candle followed by a bullish candle to understand where price rejected, find a level of support, and then continue pushing higher. Therefore, we'll simply delete these. All right, we can see where price pushed beneath this slightly and then turn around and impulse higher. So we could delete that as well to give us this as a better understanding of where support is. That initiate that bullish move. You can see that this line does not correlate to anything in particular, so we can delete that as well. You can see this one does, however, so we can just edit that and drag it out into the future. We can see this one has relevance. This one here has relevance again. This one does have relevance. So is this one. And of course, moving on up and higher, we can see that M30 did have the same level of M15 support, all right, in quite a few places. All right, so let's just continue up. For those of you guys who remember your basics education, all right, you can see we have a area of consolidation in the market. All right, I'll highlight that in red. And now you can see we got to the top of that box. Now let's get up to the 1 hour time frame and take a look how that matches on up. Well, you can see things change yet again, right? Simply put, your 1 hour time frame, your M15 time frame, right? Those candlesticks may form a little differently, and as a result, your support can be different, right? Simply put, all these time frames work hand in hand with each other. So as we get a better understanding of how price works hand in hand with each other, you guys will start to see that your lower time frame support, there's definitely a whole lot more of those. That is why your higher time frame, specifically like your H4 and your daily, your weekly, right, they hold more weight. That's because those time frames don't make as many support or resistance levels. And when they do make a support or resistance level, price respects those a lot more. You don't see a lot of breaking of those levels as opposed to the minor ones that we see. Now, if we edit this chart from the H1 time frame, right, just get our better levels of support. Right, you're gonna see that this wouldn't exactly fit. However, this would fit, right? We'll have to delete that one as well. You can see we have support here, Price is able to dip down beneath it, but ultimately push straight on upwards. Right, you can see that these two don't fit 100%. And then from there, we have our area of consolidation, the floor, the support level that's sustaining it, and then of course that upwards push. All right, so let's zoom back out to our H4 time frame. All right, and now you're starting to see, okay, well, once again, things are different. All right, and like I said previously, things will be different based on the time frame you're on. However, these higher time frames, they hold more weight, they are more important, and as a result, we can start to get a better understanding of why our H4 and our higher time frames are the time frames we use to gauge and understand our trend, and of course a concept I like to call our market flow. All right, so on a daily time frame, you can see that clears up a lot more. We have less candlesticks. Each candlestick here on this chart represents 24 hours worth of movement. And inside this yellow square, we only have one level of support down here, which caused price to turn and push on upwards. All right, so once again, just a brief video explaining support a whole lot deeper. All right, so once again, just a brief video explaining support a whole lot deeper, going from time frame to time frame. Feel free to continue to practice that exercise for some of you guys who are my beginners, and please do this with resistance as well. So we highlighted support. In this case, we can highlight resistance coming right back on down as the market made its move going into the rest of the week. All right, so we'll simply just highlight resistance coming right on down, starting off with the daily time frame. It will be up here, and then from there we would work our way down to H4. We could work our way down to H4, highlighting those levels of resistance. We'll get into our H1 timeframes. We'll get into our M30 timeframes. And of course, last but not least, get into M15 and M5 to highlight resistance as price made its way back on down to this level of support we had here on our daily H4, M5, M30 timeframes. All right, so now let's talk about supply and demand. Supply and demand is one of the very fundamental parts of the way we trade here in CFX University. Supply and demand is also what drives the market day in and day out. All right, so in this particular video, we're going to go ahead and take a look on how we can draw it, how we can identify it for ourselves no matter what time frame we're using, and then of course we'll talk about the importance of supply and demand. Let's go ahead and get started. All right, so in this video, I'm going to teach you guys how to draw it, number one. Number two, I'm going to explain some different concepts about how to accurately use supply and demand when it comes to trading. All right, so what I'm showing you here is the basic form of supply and demand. Later on in the course, for those of you guys who get access to the 5-day C section upon becoming a 5-day C alumni student after going through that 1 week highly intensive educational process, you guys will get access to a deep explanation on how supply and demand is formed. You guys will get access to a breakdown on why supply and demand is formed in particular, along with these advanced supply and demand patterns. All right, so to continue on with this particular video, all right, the basic way you can identify supply or demand in the market is going to be based on wicks. All right, so specifically, it's going to be formed and based off of the wicks, right, of candles that leads into a turnaround in market direction. So for example, you can see price was pushing bullish for 1, 2, 3, 4, 5 days, right? And upon reaching this area, supply was created, right, by financial institutions and large banks, and you can see that price turned around and dropped over the course of the next few days. All right, the area on the charts highlighted by this yellow square represents where supply can be found. All right, you can see upon retesting that same area of supply, once again supply being what causes price to push down and demand being what causes price to push up, you can see that upon retesting supply we had that same push to the downside. All right, of course when price pushed down, you can see that where did it come down to? It came down to an area in the market where we can understand demand was located based on the fact that during this huge bearish push we stopped, we turned around on a dime, and we went back the opposite direction. All right, so when it comes to supply, when it comes to demand, number one, they move the markets. Number two, price flows from supply back to demand all day long, right? In this case, we're trading inside of a range. And of course, now let's drop down to lower time frames and let's take a look to see what it looks like on the H4 chart. All right, so on the H4 chart, you can see that demand at the bottom, supply at the top, and then from there you can see that we have some other areas of supply that are inside of this bigger area of demand on the daily time frame. All right. Remember, once again, all time frames point towards the same thing, the same picture. All right. So when it comes to trading, as you guys will learn if you cover the more different nuances of Forex, daily time frame, H4 time frame, weekly time frame, those being those higher time frames that hold more weight, that they are more important. And then, of course, lower time frames holding less weight, however, just as important when used correctly. All right, so moving along with price action, let's just get back to our crosshairs. You can see that as we're flowing up and up and up and up and up, you can see that we created demand. All right, and once again, it's visible based on the fact that you can see these wicks formed, all right, indicating that price could not push down. Once again, those guys remember the price action basics. We attempted to trade south during this H4 candle, right? We failed to do so. We closed up here, right? The fact that we failed to do so, closed up here, right? We had another rejection in this area and then turn around and push bullish, indicated to us that this was an area of demand present in the market at this particular time. And then therefore, as price left this area, producing a continuation of this upwards movement, right, we could have had some kind of expectation to retest this area and potentially get a buy trade to ride price right back on up. And in this case, that's exactly what happened, right, for a total of about 176 pips, which is a nice amount of market activity, which can produce a good amount of trading profits for us. All right, now let's take a notice of something here. All right, and let's make this blue. Notice how price once again stopped on a dime, reversed, created bullish activity, right, and continued pushing upwards. But notice how price shot through this area and went on down, right? One of the key important things to know when it comes to using supply and demand is that supply and demand are not all made equal, right? Some areas of supply and some areas of demand on the chart can be institutionally weaker in comparison to others. All right. So with that being said, note we can see that price pushed straight through this area. However, it rejected at this level of demand and continued pushing higher. All right. Same thing can be said when it comes to supply. Right. Notice how we had a rejection in this area here. Right. We came back down and then we turn around and we push straight through it. Right. The reason why you will see this happen over and over and over as you're trading is because supply and demand actually gets weaker the amount of touches you've had to that area. All right. So in this particular scenario, you can see that we had 1, 2, and 3 touches, and price was able to push through that area upon the 4th interaction. All right. So whereas it's most commonly taught that support or resistance, or in this case, supply and demand, right, gets stronger every time price hits that level, right, I am now telling you guys that is actually false. That is actually incorrect. Supply and demand gets weaker the more touches you've had to any particular area. All right. So if I move forward, we'll go back to this area, I should say. You can see that after this 3rd touch and after the 4th touch, right, we were able to push through that zone and come down a little bit lower. All right. And then from there, once a scenario like this happens, this lets you know that this particular area in the chart is no longer representative of where demand can be found. And as a result, I will have to delete this highlighted area, all right, that I've used to understand where demand is. I will now delete it, understanding that after being used multiple times, it is no longer relevant. Therefore, I cannot add it to my charts in terms of understanding where relative supply or demand is located. All right. So remember, multiple touches equals a weak zone, right? A zone that has only been institutionalized once and then retested actually represents a strong zone. All right. Now, another key important thing that you guys need to know, and you may have already have seen, inside of your daily levels of supply and demand, right? You can have minor areas of supply and demand as you go down to different time frames, right? They all represent, once again, supply or demand. However, the key thing to note is price will always move from major supply, right, to major demand. And when I say that, I'm simply referring to the fact that price will always move from one higher time frame, in this case higher time frame meaning daily time frame, back down to daily time frame demand after leaving daily time frame supply. So you will see different variations. You will see institutions create minor supply, right? And this minor supply in this particular case was used for me to return back to minor demand, right? However, if I go ahead and press play on my little replay feature here, right, you can see that we had a third touch, all right? And after that third touch, once again, it got weaker and weaker the more touches it have. You can see that we were able to push through that zone, making our way back on up, similar to where we just came from in terms of this downwards movement. All right, so once again, supply and demand basics, right? Key things you must know and key things to highlight, once again, is that supply and demand gets weaker the more amount of touches that you have. Number two, right, supply or demand must be deleted from the chart in terms of how you've highlighted once prices push through it. And last but not least, daily timeframes, weekly timeframes, your higher timeframes in general typically will help you highlight these stronger areas of demand or supply on your chart in comparison to those smaller time frames that you will be using when it comes to actual execution of trades, and of course learning how to identify proper stop losses and take profit targets, etc., as you go into this course. Okay, so continuing on, we're going to cover how to edit supply and demand as we flow with price from one area to the next. All right, so I'm gonna go ahead and use the replay feature, right? This little button here that says bar replay. And let's start with this area on our charts. All right, so when it comes to supply and demand, once again, we can find, highlight, and indicate supply or demand on our charts represented by exhaustion, right, by wicks, and then of course price turning around on a dime and going the opposite way. So in this case, you can see how we're going bullish. We then exhausted in that bullish attempt, right? High of trading activity took us up here, and then from there you can see that we opened up here at a new candle. For those guys who remember how to read candlestick analysis, you can see we attempted to retest that high and push higher, failed to do so, and ultimately shot to the downside, creating a nice impulse move to the downside, right, leaving us this area on our charts to highlight relative supply during this time of market movement. All right, now once again, same scenario applies to the downside. Notice how we attempted to trade down here, indicated by that wick. The low represents the lowest price point we were able to make that day. We closed up here. The following day, you can see that we attempted to get down again, right? However, we failed to do so, and we end up closing right back on up here, right? And then from there, you can see that to the downside, we now have another indication of where demand is on the chart. All right, so first rule of thumb, you guys will find this in your text lessons, right? Your demand and your supply should never be bigger than 20 pips at the highest, right? You also want to have the truest representation of where supply or demand on your chart is located. Therefore, you need to always make sure you edit your zones, which is what we'll be covering. All right. So daily time frame supply, daily time frame supply. When we drop down to an H4 time frame, you can see that how we have multiple, in this case, 2 candlesticks, right? That is inside of our zone, inside of the area that we highlighted for demand. And of course, over here, you can see that we have no candlesticks except for these 2 that is pushing through our zone. All right, so when it comes to editing, right, when price interacts with the area of supply or interacts with the area of demand, we need to always adjust for that new interaction as long as the market gives reasons to do so. And one of the main reasons to do so is that if you get a wick that is pushing higher, than the previous ones that you used to highlight where relative supply or demand was. So in this case, this being supply, right, which I've used as a red area, right, I will simply just edit to match this new area of interaction. And then from there, moving forward, you can see that I had two rejections off this area before we finally made our way back down to relative demand. All right, same thing here. As much as possible, I do not want to cover my candle bodies, just more so my wicks. And I want to make sure that my zone is, all right, 20 pips or less. In this case, 16 pips. So that works based off the rules I like to govern my trading. And then from there, you can see 1, 2, 3 rejections. You can see 1, 2 rejections, double bottom, triple top. What does that tell you immediately? I am now trading sideways inside of a range. All right. Once again, the market primarily consolidates more so than it trends. Now, moving on into some deeper looks of supply and demand. All right. Remember, you can have supply or demand push through an area. And when it does so, it lets you know that this is not an accurate representation of where demand can be found on the chart. Now, how do we know that? Well, quite simply, if this was an accurate representation of where demand was, we wouldn't see price be able to trade and push all the way beneath, right? The fact that price stopped here and the candle closed up here lets you know that this is not accurate representation of where demand is on my chart. It would have to be further down here, right? That caused price to stop. Now, for example, let's take a look up here. All right, so initially, before price came on up into this same area again, our supply would have been drawn like this. However, notice how price pushes on up inside this area with the candle body, right? This is what's called editing for new interaction. Now, with this new interaction, the way I would just simply and quite honestly edit my supply area, right, as I was working with price in this area, I would simply move it on up so that I'm not covering up any candle bodies, right, as much as possible. And then, of course, make sure I'm catching that wick to the high side. And last but not least, measure my zone. It is only 5 pips. That is perfect. From there, you can see that you had rejections over here and rejections over here coming off that zone, providing nice little trading opportunities for intraday play, 29, 30 plus pips. But of course, just covering the basics of supply and demand. You guys are starting to see how we can edit our zones. All right. And then, of course, like I said, always match up for new interaction based off of what price does. When price pushes straight through a zone, right, then of course we know that that is no longer a representation of where supply is on the market. And of course you can see that 1, 2, 3, 4 touches, right? Once again, a zone has been made weak. In this case, a supply zone. And therefore price is able to push through it, getting up into these highs of trading activity near the daily zone that we analyzed and identified when we got on the chart. Now, let's go ahead and talk about this quick area right here, right? This long spike that is indicated by a wick, right, represents a news event, something we will talk about in a little bit later in the course. However, when it comes to news events, right, simply we can edit our charts to match up for them, right, to give us a strong and accurate representation of supply or demand in the market. All right. Once again, you can see with that edited zone. In this case, all I simply did was catch the low, and then I caught 1, 2 wicks in the process, whereas my zone was more so focused on these wicks and that one. Based off the new interaction, I then pulled my zone down a little bit. Therefore, I can still have a zone that is underneath 20 pips in size, and therefore still give me an accurate representation of where supply or demand is truly located, right? When it comes to trading, we always want to buy as low as possible and sell as high as possible. And having accurate zones that represent supply or demand on the charts helps us understand, once again, where to accurately buy or sell from. All right, so this is just a brief introduction to supply and demand. As we go on to the course, we will learn how to incorporate this with structure, with time frame correlation, and most importantly, how to trade from it. Okay, so now that we're in the intermediate section of CFX University, let's go ahead and talk about a particular subject that is very, very key and important to trading. So that topic is structure. Now, structure relates to your uptrends, it relates to your downtrends, and in this video, we're going to learn how to highlight and identify our key structure points correctly as it relates to price action. And of course, this then allows us to always trade objectively and know whether or not price is giving us an uptrend or a downtrend move. And last but not least, we'll never be lost in the sauce. Let's go ahead and jump in. Okay, so continuing on, we're going to get into a very important subject, and that is known as our trend structure. Now, your trend structure can be found on two main time frames. Number one being your daily, number two being your weekly. Now, in this course, I'm always going to reference my higher time frame structure as daily or weekly time frames, and as I also like to call them, weekly being big brother, daily being little brother, for the sake of an analogy. All right, so your downtrend, very simply, is going to be represented by lower lows and lower highs. All right, this is very classic downtrend structure. Number two, you also have your uptrend structure, which is representative by higher highs and higher lows. All right, so when you're in an uptrend, you're getting a series of higher highs and higher lows. And when you're in a downtrend, you're getting a series of lower highs and lower lows. In your text lesson below, you're going to see that I have a list of rules for how trend structure can be found and identified correctly. Number one, price must always pull back before producing a new low. Number two, price must always have a valid pullback, meaning no sideways movement, before finding that peak that produces its new low. Last but not least, number three, higher lows must lead to higher highs. If you have a pullback that does not lead to a lower low, then that is not a trend structure point. Same thing for your uptrend. Higher lows must always lead to higher highs. After getting a valid pullback, once again, it must always produce a new higher high for us to label this pullback here as a valid higher low point. These are some very key basic rules that you guys will be using to always classify your structure. That way you can always know what your trend structure points are and know what area of price action you're going to be working with. Moving on to a little bit more complexity when it comes to trend structure. Like I said before, you should never incorporate sideways movements. So your sideways movements can manifest themselves as bullish, bearish, bullish candles, right? Which are actually advanced supply and demand patterns, but we'll get into that a lot later, right? However, consolidation, accumulation, however it's formed, they are never going to be a part of your trend structure, all right? So I'm going to draw a couple of variations of price action structure movement that you may see on your charts to help you understand how trend structure can be found, can be viewed correctly at all times, no matter what you see displayed on your chart. So for example, if I'm working with a downtrend and I have a lower high to lower low, once my new lower low is produced coming from a lower high point, I will always be working inside this range of price action. Now, one thing to note, price can do whatever it wants inside this lower high to lower low, and we will always maintain our trend structure to the downside. All right, I'll just repeat that one more time. Price can do whatever it wants in between this range of lower high point and lower low point, this range of price, and it can still maintain its trend structure points. Now, let's go ahead and look at some variations that we may pop up and see when trying to understand structure. You can sometimes see price do this, pull back, create a low, not a lower low. It just comes down and create a low. You may even see price do this, come on down, All right. And so, of course, you can see 1, 2, 3, 4, 5 different peaks. However, one constant fact remains. No new lower low was produced. Therefore, none of these peaks are going to be a valid trend structure point. All right, simply because banks like to move within their trend structure points as they accumulate buy orders, sell orders, as they make their money doing what they do best. And of course, it is up to us as traders to always be able to identify what our trend is. That way, when we do get a new low, we're not surprised, we're not caught off guard because we thought that there was a switch in your structure up here. All right, so once again, just to reiterate, lower highs must lead to lower lows. I can see any different variation of movement on my chart. However, when it comes to understanding my trend structure points, it is always going to be the last peak that produces a new low that validates my new trend structure points. Once again, it's always the last valid pullback that produces the low that gives me a new trend structure point when I'm working in one range of structure. All right. So simply put, for me to say it another way, lower highs must produce lower lows. All right. When it comes to uptrend structure, the same thing can be said. Price must always produce new highs coming from your higher low. And then once again, price can do whatever it wants in between those trend structure points. And it is only until we get a new higher high coming from a valid pullback, giving us a higher low, will we go ahead and switch our movements to the very same thing. All right, now we know we're working in this range of price. And of course, once again, we're waiting for our next valid higher low point that produces a new higher high point, right? This is how we can read and understand structure and get those structural basics, all right? Okay, so to continue on, we're going to take a quick look at structure from our structural timeframes. So H4, your daily, your weekly. Of course, being your weekly having the highest amount of importance, your daily second highest, and of course your H4 timeframe. All right, so starting off with the H4 timeframe, I've highlighted lower high leading into lower low. Remember our rules for structure, guys. Price must always produce a new low for it to be a valid lower high point. And of course, price must have pulled back prior to producing that new low. So in this case, you see we've pulled back, all right, and then we produced this new low. We have a morning star pattern here. And once again, your morning star patterns are going to be one of the main key variations to help us understand whether or not we got a valid pullback or it was just sideways movement. So we have that morning star pattern followed by a follow through to the downside, giving us a new lower low. We have another valid pullback here. You can see we pull back on up from where we dropped, and then we produce a new lower low all the way down here. One more time, we pull back on up, right? This is not sideways movement, so our two rules for structure have been met. And then of course, now we're pushing down. You can see we got that bearish, bullish, bearish pattern, which we know are not structure points. Therefore, this lower high took us to this lower low. All right, you can see we have that pull back on up, once again, forming a new lower high that pushed us to a new lower low. All right, so one key important thing to understand for our structure, guys, right? We always want to have lower low, lower closes, meaning your candle body that gives us the lower low should be lower than the previous candle body that gave us that lower low. So in this case, you can see we consecutively got lower low, lower closes, meaning once again, we cannot use our wicks, right, to give us understanding of whether or not we got a new lower low. We always want to have our candle body close lower than the previous one, right? That validates and then gives us that correct lower low point in our structure. Same thing for an uptrend. So Lower low, lower close. We push down, down. Of course, lower low, lower close, because this low is dramatically lower than this point here. All right, so once again, valid pullback leading into a low, valid pullback leading to a low. So this is AUD USD, Australian dollar versus the US dollar, H4 time frame. Let's take a look at our structure now on our daily time frame. So on daily time frame, I went ahead and plugged out those points for easy understanding. And let's start from our very top. Lower high leading into a lower low. We have our pullback. Once again, lower high that produced a new low, complete validation after a valid pullback. Lower low, lower close beyond the last lower low point. And then from there, you can see we have a pullback again, producing a new lower high that then led to a new lower low. All right, giving us our validation and completion of our rules. One more time, you can see we have pullback on up. Definitely not a bigger pullback as comparison to this. However, we pull back, we lead into a new lower low, lower close. You guys can see that difference. You guys can see that difference. And then notice how we pull back on up to retest that same area that produced this lower low, giving us that double top formation. Once again, those basics of Forex candlestick patterns. And then of course you see we have that nice engulfing. And of course we follow through down into a new low. All right, so lower high into lower low. Lower highs must lead into lower lows for them to be valid. So once again, that was the daily time frame on Australian dollar. Let's just go up to our weekly time frame and let's take a look at this very same thing. So weekly time frame, lower high to lower low, right? Lower high, and notice how we do get a lower low, lower close here. However, your bullish, bearish, bullish patterns cannot be a structure point. Therefore, this is actually one huge entire move. All right, so lower high leads to lower low. We get that pullback. Lower high then leads into lower low. So this was just a brief demonstration of downtrend structure points, lower highs leading to lower lows. All right, once again, price must always pull back. We cannot incorporate sideways movement into understanding our structure. Now let's go ahead and take a look at uptrend structure points. Okay, so to continue on, we're going to look at now the uptrend structure. And here I've chosen Euro USD to demonstrate this. So we have a higher low into a higher high. And notice I didn't start from here because actually while we did push on up, we did pull back 2 candles. We had our evening star pattern and then we impulsed up to a new high. Now remember our rules for structure. Price must always pull back and then lead into a new high or new low. And so you can see despite pulling back here, none of these bullish candles actually took us to a new high. Therefore, it is only once we found this floor, and for those guys who remember your basics, you can see we had a double bottom in this particular area, and then we shot up to a new high. So higher low to higher high, we had our pullback, higher low to higher high. Once again, while we did get some bullish candles, none of these led to a new higher high. Therefore, none of them could be our structure point. So if we actually flow with price and read our raw price action, we're going to see that while we did impulse up from this area in a very nice big way, this did not take us higher than our previous higher high. Therefore, this cannot be our structure point. All right. And notice how we made our way back on down, creating a triple bottom off this level of support. And then from there, we actually did have a nice little pullback that then turned around and produced a new high. Of course, bullish, bearish, bullish variations are not our structure points. Therefore, higher low to higher high was created here. We had a nice little pullback, once again, forming a new higher low that took us up to a new higher high. All right, so this was our H4 time frame. Now let's take a look at our daily time frame and see structure being formed. All right, so higher time frame, you can see we have a higher low that takes us to a higher high. We have a pullback and then a higher low created that takes us to a new higher high. Once again, price must always pull back. And then from there, we also want the point that takes us to a new high. All right, so pull back once again. However, you can see that while we did find this floor here, create a level of support, and we did push up, we ultimately pulled back and then turned around and pushed upwards. Of course, once again, your bullish, bearish, bullish variations are not going to be your structure points. And so with that being said, your higher low was created here. And this is one whole push, taking you all the way on up to this new higher high point. Of course, once again, a pullback. We had a push on up, followed by a pullback to create a double bottom. And then from there, we impulse up to a new high. All right, so these were our structure points on our daily time frame after we took a look at our H4 time frame. And now let's close this on out with our weekly time frame. All right, so let's take a look at our weekly time frame structure. We have a higher low that then led into a higher high. We have price pulling back, and you can see we actually double bottomed in this scenario. All right, one rejection, retest, second rejection, and we shot upwards. All right, which then produced our new higher high. You can then see we came back on down, and while we attempted to go bullish with this particular candle, you can see that we actually didn't really go anywhere. So following our structure rules, higher lows must lead to higher highs for them to be valid. And then from there, you can see ultimately we attempt a second time to go bullish, right? Go upwards. And of course we failed to do so, all right? So actually our higher low point, all right, you can see we attempted now to go bullish from here. You can see we stopped. We had a 1-2 candle rejection. All right, you see just a very, very minor pullback in price. All right here. And then from there, this is actually what took us on up. So as we read our raw price action following our rules, you can see that this was the pullback that actually produced our new high. All right. So whereas your bullish, bearish, bullish, bearish, bullish variations, we know those are not structure points. We actually had a nice 2 candle pullback here, actually 3 candles once you zoom in. You see the definition of this candle. You can see the evening star type pattern rejection, followed by price pulling backwards, coming from this high point. And then from there, you can see that we made our way up to a new high. All right, so that gives us our weekly time frame structure. Let's go ahead and continue on. Furthering our education on how to understand the Forex market, we're going to take a look at now how we can have structure within structure. All right, so first and foremost, on the very left, using the split screen feature that you can find right here on TradingView, I have pulled up the daily time frame on EuroJPY along with the H4 time frame on EuroJPY. All right, so when it comes to Forex, you have what's called structure within your structure. All right, this is how we understand time frame correlation, how one time frame may show different candlesticks, however, they ultimately point towards the same thing. Now, when it comes to structure, once again, we're using those 2 governing rules. We understand how to weed out our consolidation. We understand complex pullbacks, what they look like. Now let's take a look at how we can have different structure points on H4 different from daily time frame. All right, so when it comes to your daily time frame, over here on my left, you can see lower high to lower low. Once again, complex pullback movement, lower high that produced a new lower low, lower high that produced a new lower low. However, on your H4 time frame, you can see that we actually have a different set of structure points based off how those candlesticks display themselves, and we also have even more structure points compared to our daily time frame. So on our daily time frame, inside that same area, you can see the areas that say lower high in yellow or in blue are the same structure points we have here in daily time frame. However, the points I have now labeled in green and in red are actually the structure points on H4 time frame inside the same area of price action. So starting off from our very top, we have lower high to lower low. We have a complex pullback. All right, we have a what can be seen as higher lows and higher highs. However, we know that's complex pullback. We know we have some sideways movement in the mix. However, getting onto H4 time frame, this is the pullback that produced a lower low, lower close. We have a 1, 2, 3 candle pullback that produces a new lower low. We have another pullback that produces a lower low. We dropped into sideways movement, fell out of it, giving us our H4 time frame structural lower low point. And then from there, we popped our heads back on up to H4 time frame, lower high point, and then of course producing that new H4 lower low. All right, so from here, once again, we pushed back on up. However, when we dropped, we did not drop and create a new lower low. We had our morning star pattern that still did not create a new lower low, followed by the last morning star pattern. Once again, the last peak that produces that next lower low point. And of course, because bearish, bullish, bearish variations are not part of our structure, our new structure point for our lower low after this pullback here was produced here for our H4 lower low. We have one more pullback, morning star variation, lower high point created, giving us our last H4 lower low. So you can see that while your daily time frames candles may have its structural points in one area, right, our H4 time frame can have its structural points in its own area. Now let's go ahead and take a look at how your daily time frame compared next to your weekly time frame structure points can also either differ or in some cases be the very same spot. So now as we take a look at the daily time frame and weekly time frame, right, I've went ahead and labeled the structure points on our daily time frames over here in yellow and green, and I went ahead and I've labeled the weekly time frame structure points in blue and red. So on the weekly time frame, this being the highest time frame in which we look for our structure, once again, the weekly time frame being big brother, daily time frame being little brother, you can see we have what's called structure within structure, right? One time frame structure points can be different from the other time frame structure points. All right, so if you look over here on the daily time frame, we have the lower highs that led into lower lows. Right, we have the complex pullback, of course, the lower highs that led into lower lows. But if we go over here to our weekly time frame, we're actually going to see that, well, in fact, a lot of these daily lower low and lower high points are not the same on the weekly time frame. And that's simply because we can have structure within structure. So whenever we're on a time frame, and whenever we're looking to trade that particular pair, right, we also have to make sure we identify our weekly structure points and our daily time frame structure points to help us understand structure within structure. All right, so daily time frame, as you can see, we had that last lower low. However, it was not a lower low on the weekly time frame. You can see where we have our last lower high was not a lower high on our weekly time frame as well. And in fact, most of these points that you see me deleting here don't even add up to weekly time frame structure. We can see where a weekly lower low and daily lower low coincided. So like I said, in some cases, they could be at the exact same spot. However, going back up into the rest of this movement, you can see that this lower low on daily time frame does not correlate. This lower high on weekly time frame and daily time frame don't exactly correlate 100%, whereas our weekly time frame's lower high was here. That pushed us off. On daily time frame, it is over here. All right. So let's go ahead and remove that. You can see these daily lower highs, right? They don't amount to much of anything on the weekly time frame. And with those gone, you can see that with those now gone, you can see we only had 1 point on the daily time frame that properly coincided with the weekly time frame structure points. Now, this is perfectly okay. If you're scratching your heads wondering, what's going on? Remember, you can have structure within structure. And once we understand what our weekly structure points are and our daily structure points are, we can then move forward with learning how to correlate the two when it comes to trading and understanding what one higher time frame trend it's saying in regards to the next higher time frame trend. Okay, so we've covered structure, we've covered support and resistance. Now let's go ahead and take a look at complex pullbacks. Now, complex pullbacks are something that tends to trip most people up when they're trading as it regards and pertains to your structure. So in this video, we're going to learn how to identify complex pullbacks correctly, Therefore, we can never be lost in the sauce, and we can always trade objectively with full understanding of what the market is doing. Let's go ahead and jump in. All right, so after covering how to understand and read structure along with the raw price action, we're going to actually take a deeper look on pullbacks and what is known as complex pullbacks when it comes to our structure in the markets. So first and foremost, you guys are going to see this, in which we know represents our natural downtrend structure. And of course, this, which represents our natural uptrend structure. However, we have these little things that we like to call complex pullbacks, when instead of getting a natural rotation, up, down movement in our structure, in some cases, you can find where price does something else, like this. So one variation of a complex pullback is going to be where we drop, produce coming from a lower high, coming from a lower high into a lower low. And then from there, you'll actually start to see price produce new highs and new higher lows, right? When you start to see this variation of market movement inside of your confirmed lower high and lower low points, this is what's known as a complex pullback. Simply meaning we are looking and visually seeing higher highs and higher lows, indicative of a upwards trending market. However, because we are in confirmed bearish trend structure points, we know that this is actually not an uptrend we're in. We're simply getting a pullback, or better known as a complex pullback. All right. So this is one of the very common variations you will see. Another very common variation with a lower high into a lower low. You may see price just simply push up, push down. We'll get some ranges of consolidation, break out of it, maybe even retest the broken resistance and continue pushing higher. All right. And then from there, fail to push up any higher. We reject and push back lower, break and retest off that level of support, come back down to our original lower low, and then upwards one more time. We may even do a loop-de-loop. However, once again, following our trend structure rules, simply valid pullbacks that produce new lower lows are how we get our trend structure points. So your complex pullback simply, once again, refers to any range of market activity that we can get inside of our trend structure points that don't simply produce a pullback that then produces a new low. It produces something more complex, meaning we get way more variations of market movements, all trading inside of our last valid lower high and our last valid lower low, until finally we get a new lower low coming off of a valid pullback that produced it. All right. Same thing can be said of our uptrend structure as well, by the way. Price pushes up and then we pull back. Price pushes up again, and then things start to get a little quirky, right? We start to see a series of lower highs and lower lows, what we know should be a downtrend. However, because we're in confirmed trend structure points, we know that these are actually not valid trend structure points. We're simply pulling back in a complex fashion, giving us, once again, those type of market movements that like to fake out retail traders who don't know any better. But of course, being CFX University students, you guys are getting quality premier Forex education. So you guys know how to read your trend structure no matter what's thrown at you on a day-to-day basis. So of course, that being the one of the more common, most basic complex pullback. However, similar to what I drew before, higher high coming from a valid higher low point. You're always working inside of this range of price. And of course, like I said, after getting your pullback, price can do whatever it wants. Break of resistance, maybe. Retest and reject. We come back on down. Maybe we impulse back on to the high side. We break that resistance. All right. And then we turn around and we produce a new higher high coming from this valid pullback. So therefore, that will in turn create the new higher low for us, giving us that new higher high. All right, so very crude drawings, I know. However, I just want to illustrate the fact that once you have confirmed trend structure points to your low to your high side, or confirms trend structure points from your um higher low to your higher high. Once you have confirmed trend structure points coming from the lower high into a lower low or a higher low pushing up into a higher high, you are always working inside this range of price action, and price can always do whatever it wants. It is only until you get that new high coming from a valid pullback. All right, the floor that produced it is going to give us a new higher low point to a new higher high point. And then, of course, the same thing applies. We start that process all over again. Typically, in the way the banks move the markets, they very rarely like to just push price down and up after one pullback, right? Not that in which it cannot happen. In some cases, you can see a very clear trend in market where we just get one valid pullback and then we get a continuation of price to a new low. However, in some situations on the markets, banks like to play around in what I like to call the sandbox in between your trend structure points, getting as much orders filled as possible before they continue to the downside, or of course, potentially taking profits off their trades before continuing to the downside or upside, depending on your trend structure. So that is what's important to note. That's what's important to understand when getting complex pullback. Now, in the following video, let's take a deeper look at this on the candlestick chart so we can identify complex pullbacks relative to our trend structure. Okay, so continuing on with our education on complex pullbacks, we're going to take a look at Australian dollar versus Japanese yen. So on this particular pair, you guys can see I have the H4 time frame pulled up, and I've already went ahead and labeled, of course, your structure points. And now we're going to walk through price action, understanding how sometimes we can get complex pullbacks in our structure. However, once we have our proper validation using our very specific rules for structure, we know how to identify our correct structure points and not get faked out. All right, so starting off here with our very last, we have a higher low that led to a higher high. And of course, now if we walk ourselves back, you can see that we did pull back. We created a floor here, level of support. And then you can see we tried to impulse higher, giving us a new higher high. However, we failed to do so. You can see we rejected. However, you can see that we pulled back and we got a slight lesser close in terms of this low compared to that low. And we impulse up again, right? Trying to go high. However, once again, we failed to do so. Then from there, we pull back on down. We had a 1, 2, 3 triple bottom. Finally, we impulse up into a new high. Now, as we read price action going on up, of course, you can see that we had our bullish, bearish, bullish patterns, which are not our structure points. You can see we had another one followed by a third. Finally, we created a new higher high along with our nice low double top variation. And then from there, we pulled on backwards. Now in the process, for those of you guys remember your support and resistance basics, you can see we did have a level of support. We did break, retest, and come back on down. However, once again, following our structure points, we have a higher low and higher high. And like I said before, right, we can move anywhere inside the range between a higher low and higher high. However, it is ultimately only when price creates a new higher high, and of course the floor that produced it, the support level that produced it, can we get our proper validation for our structure points. So you can see in this particular fashion, we had a complex pullback, right? We had a break of support, we had price pushing lower. You can see where it actually looks like we were getting a lower high and a lower high coming back down to the support. However, one key thing to always remember, once you're in a confirmed uptrend based off of your daily and your weekly time frame structure, right, we can never call the opposing points, or rather what looks like lower highs and lower lows, we can never label them as such because we know we are in an uptrend structure. Therefore, when it looks like we're getting a series of lesser highs, all right, inside of our structure, which we know is an uptrend, that's when we know without a shadow of a doubt that we are getting a complex pullback. So once again, we have a floor, we have that pullback that then produced a new higher high. And notice once again, we even break a level of support here and here. All right, and then from there, we turn around and we start to continue back on up. Now notice in this particular area, while this did produce a nice little bullish push, it did not create a new high higher than the previous higher high. Therefore, this cannot be our higher low point. All right, from there, we can see we actually did pull back. All right, and then from there, this brought us up to give us a higher high, higher close beyond this structure point, giving us now our new higher low point to new higher high point. So this entire move in between creating new structure points was once again going to be our complex pullback, simply meaning we are not getting a very linear push up to a new high, pull back down to a new higher low, push up to a new higher high. In this case, we're getting more candlestick movement, we're getting more candlestick development. However, ultimately, when it comes to reading our structure points, we know our rules, and therefore there's no need for us to get lost in the process, or rather get lost in the sauce when we are, of course, looking for our trend structure points. So as the market continued to develop, you can see we had a nice pullback. You can see we did create a level of support here, indicated by this bullish candle, and it's in this attempt to go upwards. However, we failed to do so. We came back on down, rejected off of this same floor that produced a higher high point. And of course, once again, you can see that we rejected, giving us that nice double bottom before producing a new higher high. So this, once again, is how we read our structure, how we understand market movements in between our structure points, when we can start to see breaks of supports, or even when we see what may potentially look like a lesser high, a lower high. Once we are in a confirmed uptrend, we know that if we see the opposing structure, that is just simply a complex pullback. All right, so this was the H4 time frame. Let's go ahead and take a look at the daily time frame to see what that looks like. So in the daily time frame, I've highlighted your key important structure points, and let's go ahead and read our price action starting from the very bottom of how we produce a series of higher lows and higher highs while getting a complex pullback. All right, so we see we have the start of the push. Of course, we know our bullish, bearish, bullish variations on our sideways movement are not going to be our structure points. So in this case, we have a nice rally from the low to the high. You see we had a nice clean pullback followed by a nice clean continuation up to our higher high. These are a nice structural moves, of course, that everybody loves, right? When price just simply gives you a new higher high coming from a previous higher low, a nice clean pullback, then continues upwards into a new higher high. But in some cases, however, we can get scenarios like this. So we see we pulled back to create a new higher low, that valid pullback coming from the high. We then turn around and we pushed up. Of course, once again, your bullish, bearish, bullish variations are not your structure points. And then from here now, let's see how things can potentially get tricky, of course, if you don't have the correct rules and understanding of your structure. So with that being said, you can see how we created a nice double top variation. We came down, we broke our level of support. We actually retested on the opposite side. All right, and then we came back on down. However, despite coming back on down and breaking support and retesting on the opposite side, right, one simple fact remains. Well, number one, this is our structure points, our last valid structure points as we're walking ourselves to this area. Therefore, like we know, price can do whatever it wants in between your range of structure. So in this case, your higher low created that higher high, and you see we impulsed and made our way right back on down to our last valid higher low point before then summarily rejecting from it. And then from there, you can see we started to push upwards. However, we failed to do so. We came back on down. However, if we look at this in terms of market movement, you can see potentially we're getting these little, what can be seen as lower high points. However, we know that these are not lower high points because we're in a confirmed uptrend. Therefore, these movements are simply our understanding we're getting a complex pullback relative to our last valid structure points. All right. Now to continue on with the price movement, you can see that we impulse higher, we came back on down. We created a new floor slightly higher than the previous floor we rejected from. And then from there, you can see we're impulsing, we're moving upwards higher and higher and higher. All right, you can see from there, we did have a range of consolidation in this area. And so ultimately, of course, with consolidation not being areas that we use for structure points, we're going to be looking at this as one big push that took us from a higher low to a higher high. All right, so once again, complex movements, complex pullbacks inside of our structure points. That simply lets us know, hey guys, we're always pushing upwards. We're always in an uptrend. However, we can have some periods of market movement of price activity where it's not a clean stair-step pattern like I normally say. All right, price can simply, in some cases, price can give us, once again, what looks like lower highs and lower lows before finally finding a floor it cannot break and then impulsing up to a new higher high. And this would then be our new higher low. Now, let's continue on with the weekly time frame just to take a quick look. Of course, once again, I've done the favor of already mapping out these structure points. Now, let's simply walk through our price action and get a better understanding of these complex pullback movements. So, of course, with a higher low going into a higher high, you can see once again, we came back, we created a floor. However, this did not produce a new higher high. All right, therefore, it cannot be a valid trend structure point. From there, you can see we pull back, and then this floor here is actually what produced a new higher high, higher close. Once again, candle bodies closing higher than the previous points. And then you can, from there, you can see we pull back one more time, producing new higher high, higher close. Now, take a look at this particular area that I've highlighted. You can see we pull back to create this floor. We attempt to go bullish. We attempt to go right back on up. However, we fail to do so. And in the process, you can see that we drop back beneath this level of supports. However, we ultimately rallied on up to a new higher high. So with that being said, this is what's called an overshoot of your support level or of your structure point level. Also, we can classify this as a tested area, meaning price tested and attempted to break. However, it failed to do so. And we ultimately rallied to the high side, letting us know that this was not a proper break because we did not get a retest and follow through to the downside. Now, that particular concept, retest and following through, is part of our understanding of transition, how the market changes direction, moving from one direction to the next. And that is the subject we will cover just shortly as we get ready to wrap up this particular part of our video covering uptrend structure. So moving on with our price action development, learning how to read raw price action, factoring in our complex pullbacks, you can see that we had a push up that led into sideways movement. All right, and with that sideways movement, you can see that we finally found the peak of the sideways movement. And then from there, you can see that we pulled backwards to create that new higher low point. All right, so price pushed up, went sideways. We have our peak, meaning we have that higher high. We fell back on down. We double bottom, and then from there, we rallied on to a new higher high. All right. From there, we pull back one more time. We rallied on to a new higher high, higher close when it comes to the candle bodies. And from there, you can see we pull back to retest that same similar area of support. And then we produce that next higher high in this particular demonstration. And so you can see, you can have your movements, once again, that may seem complex in the way we pull back before we lead to a new higher high. Now let's go ahead and take a look at this in downtrend structure, lower highs and lower lows. Okay, so taking a look at Euro JPY, we're starting off with the H4 time frame, and we're going to cover the downtrend structure while we observe complex pullbacks that came in during the creation of each new structure point. All right, so starting from the very top, we have a lower high that led into a lower low. You can see we had a pullback followed by our morning star pattern. Then from there, a lower high that led into lower low. Once again, you can see a slight morning star variation. Once again, those are going to be your key differentiating characteristics that help you understand whether or not you got a valid pullback, even if it's just one candle or two candles that's giving you the pullback. So your morning star variation, here, once again, lower high, producing a lower low. Once again, your bearish, bullish, bearish variations are not going to be your structure points. From there, we pull back on up, we continue lower. Now, here's where things can potentially get a little bit tricky. Once again, once you have a lower high into a lower low, we know that as far as structure is concerned, price can move whatever it wants inside that range. And you can see we ultimately made our way all the way back on up to our last confirmed lower high point as we got this drop. However, you can see what looks like a higher low that then produced a upwards move. You can see what looks like a higher low that then produced a upwards move. And in this case, you can see what potentially can look like a higher high and a higher high. However, like I said, once you know you're in a confirmed trend, whether it be a downtrend or an uptrend, in this particular case, it is a downtrend. We know that once we have our confirmed trend structure points, unless we get a trend structure switch, then we know we're always working within these particular points. And then therefore, this is just going to be a complex pullback. So to continue on, you can see we had that lower high that led into our lower low. You can see we had that pullback, and then of course the lower high that then leads into our lower low. Now notice we dropped and we simply traded sideways. From there, we fell on out. So of course, with our consolidation not being valid trend structure points, we would have produced a lower high that came to this lower low. Now, of course, moving on, you can see we had a pullback. You can see floors were created and maintained, almost if price wanted to go higher. Ultimately, however, we failed to do so. We pushed on down. We had a lower low, lower close, giving us a new lower low point in our structure points. Here we go. Pullback, drop, sideways movement, producing that lower low. Now, let's take a look at this area here. Notice that if this is our lower low and this lower high is the area that produced it, then of course, if none of these areas takes me lower, they cannot be lower high points. And notice how we had even had a attempt to go bullish. We had floors being created. Ultimately, however, price did not give us a proper trend structure switch. Therefore, we rejected, we came back bearish. We moved sideways, once again, not part of our structure points. And ultimately, we fell and made our way down to a new lower low that gave us a valid pullback one last time to create a new lower low. All right. So this is how, once again, we can read our structure, understanding complex moves, complex pullbacks inside of our structure points. Ultimately, however, if price does not break, retest, and follow through beyond our structure points, then we have not had a proper structural switch. Now, let's go over to our daily time frame and take a quick look at, once again, another example of a complex pullback. So in this particular area, you can see that we were in a downtrend on Euro JPY daily time frame, all right, being these structural time frames. And from there, you see we had a lower high that led to a lower low, a pullback, lower high that led to a lower low. And then now notice we were moving inside of our range of this last valid lower high to lower low for quite some time. All right, you can see we had what can be viewed as higher lows, double bottoms, as price attempted to make its way higher. All right, ultimately, however, because we are in a confirmed downtrend, right, we know that this is simply a complex pullback to our lower high structural points. From there, you can see that we attempted to push lower here, and we attempted to push lower even here. Ultimately, however, with our specific rules, we know that lower highs must lead to lower lows. So because this area, nor this area up here led into a new lower low, lower close beyond our structure point, it was only when we got this valid pullback, all right, that then led into this low, that we get new trend structure points. And the entire time, this was simply one huge complex pullback inside this two structure points. Now, as our structure developed, you can see we had lower high to lower low. Once again, notice how we had a pullback. However, we did not push lower. Therefore, this could not have been our lower high. And once again, notice how we had another pullback that did not lead into a new lower low. Therefore, we have another point that cannot be our lower high. Once again, we are getting a complex pullback inside of our last confirmed legs of structure. And finally, last but not least, it was only when we got this pullback, we did produce a lower low, lower close beyond this point here. All right, from there, you can see we pull back on upwards to create this lower high. We fell to a new lower low, one last pullback to create that next lower low. So once again, just to quickly recap, you can see we can have pullbacks that, however, don't lead to lower lows, or you can see where we can have a series of higher lows, what may look like higher lows, I should say, inside your confirmed structure. However, unless your trend structure was switched, you know that that is simply a complex pullback. Now let's take a look at the weekly time frame as we get ready to wrap this up. You can see that on a weekly time frame, we had a lower high that leads into a lower low. All right, you can see we pulled back, we dropped, sideways movement, continued to our new lower low. You can see we had a retest for a slight double bottom, all right, and what potentially could be viewed as a higher low because we pushed up higher like this. Nonetheless, we know we're in confirmed downtrend. Therefore, these were those 2 points. This is the complex pullback. This is continuing to the downside. Now, here's another good teaching point. Notice how we even managed to get higher here than your last confirmed lower high point. However, because we did not break, retest, and follow through, transition, right, which we will cover shortly, we did not get a proper switch in our structure. And from there, we fell, we pulled back one last time, we dropped and went sideways. Of course, sideways movement, not going to be the variations we use. Therefore, this was the pullback that produced this new low. All right. Once again, the complex pullback ensued. We pushed up, we pulled down. However, no new low was created. We went even higher. We retested that floor. However, still no new lower low. This was still the last valid lower high. It was only once we created this last pullback did we produce a new lower low. Once again, just to wrap this up, you can see we pulled back. We had a minor drop. However, we did not produce a new low. We double topped here at the level of weekly resistance. And from here, this lower high led to a new lower low. So this is how we can read our price action objectively, understanding we can get complex pullback moves inside of our confirmed trend structure points. However, unless we get a proper transition in structure to switch our trend, we're always working with our last confirmed points, understanding price can do whatever it wants in between that range. Now let's take a look at the complex pullback that involve sideways movement, which is what we know as consolidation, also known as a range, also known as accumulation. All right, so on the screen here, I've went ahead and labeled out some different variations that may present themselves on the chart. However, when we use specific rules, we can always identify what our structure points are, even when we come across areas of consolidation, sideways movement, which we know have no part in being our confirmed trend structure points. So starting from the very top, number one, you can see that we have the clean trend structure that we all know and love. Lower highs that lead into lower lows, one clean pullback, lower high that leads into lower low, another clean simple pullback, and of course, leading into a new lower low. Now let's take a look at some of the variations we may see on the chart when it comes to sideways movement, and of course, how to understand them. Now, the very important rules of structure still come into play. Number one, price must always pull back. And number two, after pulling back, that last peak must lead into a new lower low when we're talking about downtrend, and of course, vice versa when we're talking about an uptrend. So in this case, number two, you can see that we dropped from a lower high leading to a lower low, and then we pulled back, meaning number one, we've gone that first rule. However, we then consolidated, we moved sideways. However, because rule number one was fulfilled, then from there you can see this last peak in your consolidation produced a new lower low, that lets us know that both rules were confirmed, both rules were completed. Therefore, it is okay if we pull back and then go sideways. Because number one, we pull back, which is the first validation for structure points that we're looking for. And then number two, this peak produced a new lower low, therefore making it the new lower high as we continue down in our structure. All right. So once again, as long as we pull back, we can have our sideways movement, but most importantly, we have to pull back and then lead into a new lower low. Let's take a look at variation number 3. Once again, downtrend structure, lower highs and lower lows. You can see that we came from a lower high into a lower low, and then we traded sideways. All right. So we haven't had a pullback yet. We've simply been bouncing back and forth inside this range of consolidation. And then from there, you can see we pulled out of consolidation, we found our peak, we had our pullback, and then we produced a new low. This is a common variation of structure that you may see. And quite simply, we always use those same two governing rules. Price must always pull back and then lead into a new lower low. Continuing on into our fourth variation, we have quite simply price drops. We just consolidate. We never once pop out of consolidation. We just simply roll on into a new lower low. So in this case, in these variations, this will quite simply just be a lower high into a new lower low. And of course, during the sideways movement, we did not get any new structure points. So here you can see in variation 5, you have a complex pullback that involves consolidation, right? So here you can see we fell from a lower high into a lower low. We then traded sideways. We popped out of consolidation. We dropped. We pulled back another time. We dropped again. However, because these 2 points did not produce any new lower low, these are not going to be our trend structure points. Once again, once you get your valid pullback, your trend structure point that creates your new lower high is always going to be the last pullback that created a peak that then followed through to a new lower low. So in this particular case, you can see that this last peak that created this pullback produced that new lower low, giving us our confirmed trend structure points. All right, so this was just some quick variations, some quick examples for downtrend structure. Now let's go ahead and take a look at uptrend structure and the different variations you can possibly see. So now, getting into the uptrend structure, you can see starting off with number 1, you have higher lows that lead to higher highs. And of course, you just have the clean, simple pullback, producing new higher highs, pulling back once, creating a new higher low, creating a new higher high. Those are the trending movement structure points that we absolutely love as traders. However, things are not always so clear, so linear when it comes to the market. Sometimes we can see different variations. So let's go ahead and dive into them. Moving on into number 2, you can see we have a higher low that leads into a higher high. We then pull back and we go sideways. However, because we had our pullback, we got our validation of rule number 1. And then from there, the last peak that then produces that new high is going to be our new trend structure point that gives us a higher low to a higher high. Moving on into number 3, you can see we have a higher low that gives us a higher high. You can see that we then traded sideways. However, after trading sideways, we broke out to the downside, giving us our valid pullback. And then from there, we sprung to our new higher high. All right, so once again, rule number 1 for our valid trend structure points, we had that valid pullback. All right, number 2, we produced a new higher high. Getting on to our 4th variation, you can see quite simply we impulsed up. However, we just bounced back and forth going into sideways movement. We did not pull back out of consolidation once we got into it. Therefore, we simply just continued upwards. And of course, meaning this is our higher low to that higher high. All right, moving on to our 5th variation. We're going to see a higher low that pushed up into sideways movement. Now, similar towards what we saw here with this particular movement, we actually impulse up out of the consolidation. We shot on up, we popped out, and then from there we found a peak. Now, because this is the higher peak and because this was consolidation, quite frankly, this is actually going to be our higher low to our higher high point. And then from there, we had our pullback to create a new higher low, of course, producing a new higher high point. All right, so once again, the charts may not always be clear and linear. We can see some different variations. However, as long as we know how to read raw price action, understanding the two rules we use when it comes to our trend structure points, and we understand we can get complex pullbacks in the mix, we can never be lost in the sauce when it comes to reading our structure. All right, last but not least, with our sixth variation, we have a higher low that produced a higher high. From there, we traded sideways. However, we ended up breaking out of the range of consolidation, that sideways movement. And from there, you can see we pull back to find the floor. Now, even though we have what looks like a series of higher lows, once again, to get our valid trend structure points, the higher low that produces the higher high are always going to be the points we are looking for. Therefore, these would not be our trend structure points. Rather, it would be this one, because this pullback created this peak that then led to a new higher high. So those are just some of the different variations we can see when it comes to our structure points, when it comes to the different variations that price may throw at us. However, because we're using our two defining rules, because we know how to read raw price action along with complex pullback movements, right, we can always stay on top of the game and trade successfully, objectively, maintaining our structure. Okay, so having covered complex pullbacks, let's now talk about structure and complex pullbacks as it pertains to consolidation. Now, consolidation is an area of the market that can typically be identified by price moving sideways inside of a range. While consolidation typically trips most people up as it pertains to structure, in this video, we'll learn how to incorporate it when it comes to our understanding of complex pullbacks. And then last but not least, it'll allow us to always know what the market is doing as it pertains to structure, our trends, and of course, reading raw price action. Let's go ahead and begin. So we covered how to understand sideways movement with those complex pullbacks when it comes to our structure. Now let's take a look at some visual examples with candlesticks analysis. All right, so starting off at the very top of my screen, you're going to see I have highlighted the lower high point that led to our lower low. Now notice we were in a range of consolidation previously. We popped out, then we double top, and of course the last peak that produces the lower low is going to be our structure points. All right, from there you can see we popped up, once again giving us a pullback, and then from there we went sideways. We even pulled back further with some more sideways movement before we fell off into a new lower low that stopped right here. So once again, it is okay if we pop sideways. However, after the sideways movement, after getting our pullback, it's always going to be the last peak that produces the new lower low. From there, we got a nice one candle pullback morning star variation. Once again, the morning star or evening star variations being the significant defining factor to understand whether or not we're going to use the one candlestick or two candlestick that give us pullbacks before continuing that trend movement. Okay, so notice how we have that nice pullback, of course, 1-2 candles, then we impulse down into that new lower low. We get a pullback, of course, with the morning star variation. We rotate to a new low. However, notice that despite getting this bullish candle, followed by then a bearish candle of complete size, that put us into the realm of sideways movement, meaning we did not get a nice morning star variation, even though we rejected off this level, giving us a double top variation, you can see that, however, we had a bearish candle followed by a bullish candle followed by a bearish candle that then, of course, took us lower. So when we do have these one candle pullbacks, that Morningstar variation helps us get a better understanding, of course, of whether or not we pull back, we peaked, we now ended that bullish pullback movement, and now we're getting ready to continue our bearish movement with the following set of candles. In that case, that would then make our lower high point from here to here, lower high to lower low. From here, you can see we got a nice complex pullback. We saw price actually angling up higher and higher and higher. You can see we retest the last lower high points, of course, giving us now a triple top variation. From there, with the pullback being given, the last peak that then produces the new lower low is going to be our structure point. So we have a lower high that led into lower low. From there, you can see we had another complex pullback variation. Price pushed higher. However, we did not rotate to a new low. We actually turned around and pushed even higher. So while it may look like a higher low and a higher high, once again, when we are in confirmed downtrend structure points, we are always working inside of that range until we get a confirmed trend structure switch. So in this case, we just had a complex pullback. Lower high led to a lower low. Lower high led to a lower low. Once again, nice little Morningstar variation. Lower high leads into a lower low. All right, 1-2 candle pullback. Nice Morningstar variation. Lower high leading into a lower low. Now notice how we push back higher. However, from this point, we did not drop and create a new lower low, lower close. We just simply had a double bottom. And from there, we pulled back with another Morningstar variation that then took us to a new lower low. All right, so thus making this the last lower high and lower low inside this downtrend structure movement. So once again, understanding those rules in which we use to classify our structure points, we can get a nice understanding of whether or not we want to ignore an area of consolidation, find the point in which price pops out of consolidation when in a downtrend, or find the area which price pops out of consolidation when in an uptrend to get our better understanding of our correct trend structure points. Now let's go ahead and take a look at this on the uptrend structure side of things to make sure we have a clear understanding of reading raw price action and structure. All right, so starting off with our very bottom left corner, you can see we have a higher low that then produces, all right, a higher high. Once again, sideways movement is not going to be part of our structure points. So you see we popped up, we went into sideways movement. All right, we finally popped out of consolidation, giving us the higher high points. All right, and with that higher high point, you can see we then pull back to a floor that produced the new next higher high points. All right, so with that being said, let's go ahead and take a look at how we moved into this range. You can see how we pushed up, bullish, bearish, bullish variation. We know those are not structure points. Now notice how we went sideways again. So, right, so once again, we need to pop out of our range of consolidation. However, in this case, we pushed up, we went sideways, and this is spawning where we popped out of our range of consolidation. All right, so with this pop on out, giving us the peak for our higher high, you can see from there, we made our way back in a complex pullback fashion to create this floor that turned around and gave us our new higher low point because it produced the next higher high. Now, quite similar to some of these market movements, once again, you have your higher low that then pushes up. However, notice we push up, we have a bearish candle, then we have a doji candle, and then a continuation upwards. However, we did not have a pullback here. We just simply printed a bearish candle, and then from there, printed a doji candle. So of course, that's going to mean with no valid pullback, this is one nice little push. From there, you can see we had a 2 candle pullback, retested as low support, and then from there, this took us on up. Now, as we're flowing up with this bullish price action, right, let's go through and let's look at the details to make sure we're understanding how we're getting our correct trend structure points at all times. Now, we had our bullish, bearish, bullish variation, which we know were not trend structure points. Notice how we even get a Morningstar variation here. However, we didn't pull back. This candle is in fact smaller in size than the previous bullish candle. So not really much of a pullback here. meaning we're going to go ahead and label this in our sideways movement category until finally we got this peak that came from this higher low. And then from there, you can see that we got another complex pullback, what can maybe viewed as lower highs, leading you down into lower lows. However, once you're in confirmed trend structure, like we've said, we know that this is simply a complex pullback. So from here, you can see that we dropped down, we turned around, tried to go higher, we came back on down, we traded sideways. However, we fell back from our initial higher high, meaning we've gotten our pullback. Now we need to identify the point that produced the next higher high. Now, this was the last floor that was established for us. All right, and you can see this floor produced this 1-2 candle upwards movement, followed by sideways movement, followed by a doji, followed by a bullish continuation to the new higher high point. Therefore, this would end up being the pullback. This would be my higher low, the floor that produced this move. And because our sideways movement are not going to be a point of, and because our sideways movement is not going to be a part of our trend structure points, we would have to look back and find the floor that produced that new higher high point after getting our pullback. So from there, to continue on, you can see that we had another pullback. Of course, we found that floor, and last but not least, we impulse on up into a new higher high, higher close. All right, so this is how we can walk ourselves through price action, understand sideways movement, know we're looking for valid pullbacks, know we have to either pop out of consolidation or pull back, then go into some consolidation, find the last peak that then produces the new higher high, or in the case of a downtrend, produce the new lower low. So now let's go ahead and dig deeper into how we can identify a proper trend structure switch. All right, so starting off with the first example, you can see that we were in an uptrend. We were getting a series of higher highs and higher lows, right, highlighted there in yellow. And then from there, you can see that we broke our last higher low point, right, with this impulse move to the downside. We retested, and then of course we followed through. And then from there, we got a series of lower highs and lower lows. So when it comes to identifying a proper trend structure switch, one of the most important things you guys have to keep in mind is that you can only get a trend structure switch, number one, on either your daily and weekly time frames. And then of course, number two, for you to get a trend structure switch, price needs to break, right? Price needs to break, retest, and follow through. And that break, retest, and follow through process must involve your last valid higher low, right? That is the only way you can get a true trend structure switch. So let's go back to example number one. Let's take a look at it. You can see that while we had a various different higher lows and higher highs, we only could observe a true trend structure switch when we broke our last higher low points, retested, and then of course followed through to the downside. All right, so this is a very clean uptrend structure movement. All right, once again, the breaking of that level, and of course your higher low point is going to most likely end up being some kind of support level as well on your daily time frame. Of course, once again, once price breaks your higher low point, retests and follows through to the downside, that's what gives you your confirmation of a proper trend structure switch. Now let's go ahead and look at scenario two. Slightly different market movement, however, same rules apply. You can see we're getting a series of higher low, two higher highs, higher low, two higher high, and then last but not least, you can see we had a higher low that produced this higher high. Now this is not a higher low because we know, once again, when it comes to our structure rules, price has to produce a new high for it to be a valid trend structure point. So in this particular case, we did not have that happen. Therefore, this was just simply a floor or a support level on our daily time frame. And then of course you can see that this peak produced the move that broke beneath our last higher low point. From there we retested and we followed through to the downside. Of course then a pullback, and then of course a new lower low. So once again, those are the very simple rules we use to identify our trend structure. Over the course, we will cover how to look at this from a actual candlestick perspective, but just to recap on these very specific rules, which you can also find in the text lesson beneath. Once again, price must break the last valid higher low point. If you're in an uptrend, you must then have your pullback, your proper pullback, and then of course you must follow through lower. Now the way in which price does this is actually called transition in your structure. All right, transition in your structure is another name for trend structure switch. All right, so let's go ahead and look at this now from a downtrend switching into a uptrend perspective. Okay, so here on our screen, we have the downtrend version of this visual example. And so of course, starting with number one, we can see we have lower highs that led into lower lows, lower highs that once again led into lower lows. And then from here, you can see we had a lower high that produced a lower low. However, you see me highlighted both this as a yellow and a green circle in this particular example because the same rules apply. This is the point that produced the breakout, that produced the move that took us above our last confirmed higher low point. Therefore, in this trend structure switch, this lower low point also serves as our new higher low point in this trend structure switch. So if we're reading this, we can see that we had a break above our higher low point. We had our retest, and of course we had our follow through. We had our pullback to a new higher high, pullback to a new higher high. All right, so once again, those same rules always apply. We must always pull back. And then of course, after pulling back, produce a new high or new low. All right, now let's take a look at another variation of this. We can see we have a lower high that leads to a lower low. Once again, lower highs into lower lows. And then from there, you can see we had a range of sideways movement. You can see we had that triple bottom scenario. All right, a double top scenario up top. However, because these 2 points up here are not trend structure points, meaning they did not produce any new lows, these are just resistance levels, or also what I call a ceiling. All right, so it is when price broke above, once again, our last confirmed lower high point here, retested, and then followed through to the upside, producing a new higher high, did we get a valid trend structure switch. All right, so lower highs leading to lower lows. Once we break our last valid lower high, we must always then pull back and then of course follow through, giving us the confirmation of a proper trend structure switch. So delving deeper into how we can view a trend structure switch, I've pulled up British pound versus the Swiss franc on the daily time frame. Now I went ahead and plugged in the points. Now let's go ahead and walk ourselves through this switch from a downtrend to a uptrend, and of course properly understand how to view it and do it for ourselves on the chart. Now starting with the very most left corner of the screen, you can see we had a lower high that led into a lower low. Of course, lower highs leading into lower lows. Now you can see this was actually the last valid lower high point, because once again, we're not going to use sideways movement. This was the last valid lower high point that led into a lower low. From there, you can see we're getting a complex pullback inside of this trend structure point. Now from here, actually, this floor, this point is actually what produced the breakout above our level of resistance, above our lower high point. And then from there, you can see we pulled back and we produced a new higher high, completing our transition in structure. And then from there, we were moving in an uptrend. So of course, higher low into higher high. You can see while we did pull back here, and while we did break some support levels in the process, this was our higher low point that produced a higher high. We were working inside this range of structure. And then from there, you can see we pushed up. We had a 1-2 candle pullback with our evening star pattern. Then from there, we pushed up and created a new higher high, higher close. So that gave us our new structure point to the next higher high. Once again, valid pullback, higher low, producing a new higher high. All right, I've went ahead and highlight this point here. Once again, that evening star pattern producing that new higher high. We pulled back. You can see now we're pushing up. However, let's take a look at this. All right, while this produced our move, we also had a slight variation on where we had our evening star pattern that then produced this bullish movement. So if we're asking ourselves, is this our higher low or is this our higher low? Well, we also want to go with the pullback that produces our higher high. So in this particular case, we would have our higher low here. And then from there, you can see that we had our nice double top variation. So going back into the move, you can see we had our trend structure switch. And of course, how that rotated us from a downtrend into an uptrend, giving us these trend structure points. Okay, so taking a look at another example, we have the British pound New Zealand dollar. All right, and let's go ahead and break this down. So you can see starting from my very left, I've highlighted the lower high that led into lower low, lower highs into lower lows, and last but not least, the lower high that produced this lower low. Now from there, you can see that we impulsed up, we broke above this last valid lower high point, we pulled back, and then of course we followed through higher. Those are our specific requirements necessary for a trend structure switch. So in this particular case, you can see where we had the break above the lower high point, the pullback, and then of course the follow through, giving us the transition in structure. From there, you can see we had a new higher high, higher close. You can see price pulled back, attempt to push higher, kind of just double top in this scenario. And then from there, you can see this higher low pushed up to create this new higher high. You can see we had a complex pullback in the mix before this higher low impulsed us up to the new higher high point. And then from there, we've just simply been working inside of a range of consolidation. All right, that's sideways movement. So when it comes to viewing our trend structure points, like we said before, for us to get a true switch in our trend from an uptrend to a downtrend perspective, it has to involve the last lower high point in a downtrend or our last higher low point in the uptrend. Upon breaking above, breaking beyond it, we need to always then have a pullback and of course a follow through taking us higher than the breakout, giving us a proper transition in our structure. Now, let's go ahead and take a look at this from the perspective of a uptrend that transitioned in structure to a downtrend, giving us a trend structure switch. So starting off with our very left, you can see we had a higher low that produced a higher high. And of course, we have that 1, 2, 3 candle pullback that produces the new higher low. From this point forward, we move on up to create our new higher high. Now, of course, following our trend structure switch rules, you can see that we had a move that broke us beneath our higher low point. From there, we had our pullback that then produces our new lower low. At this point, we had our confirmation of our switch, therefore putting us into a downtrend. Now we know we were working with our range of structure between lower high and lower low. All right, so from there you can see we had a complex pullback movement inside of our structure points. Ultimately, however, it was when this point here produced this lower low did we actually get our next set of structure points. Now I picked this area to highlight a particular area in the market that we have to be a little bit mindful of, right? So of course, with our structure rules being, we need to have a lower low, lower close. If I move this away so we can take a look at it, you can see that while getting a lower low and lower close on this level of support where our lower low was, this also closely resembles a tested area of support. Be mindful of these kinds of price activity and always make sure we do push through to form a new low at a lower point. So in this case, you can see that that did happen. After pulling back on up, we got a Morningstar variation. And then from there, we pushed through to the downside, creating this lower low. From there, you can see we came back on up. We failed to go lower. We retested for now a triple top variation. Still failed to go lower after falling back down. it was finally this last pullback that produced our next leg of structure. So of course, making our way down, not including the sideways movements, you can see we finally got a new lower low. Now, of course, same thing happened again. All right, so once again, while we may have gotten a lower low and lower low close, this also, once again, closely resembles a tested area of support. So we must always be mindful of these areas to make sure we do indeed push lower to help us understand that this is actually price trading and closing and staying below this level of support and not just a tested area of support. So of course, now going back into it, you can see how we switch from an uptrend into a downtrend, following our rules, and of course, getting a better understanding of how to view a true trend structure switch. Now, this same thing applies to weekly time frame as well. So do, however, keep that in mind. For you to get a trend structure switch on your weekly time frame, you have to involve weekly time frame structure points doing this very same process, breaking, retesting, and of course following through to give us our transition in structure. So starting off, let's take a look at how M5 time frame, M15, M30, H1, no matter what time frame you're on, how everything paints the same overall picture. All right, so once again, because price knows time, we know that we need to be able to correlate one time frame to the next to help us understand what price is looking to do in the short term and in the long term. So what I have highlighted for you here is a day worth of movement on GBP JPY. All right, so of course, when it comes to Forex, we do not actually run from 12 to 12 like we normally do. We actually run from 5 p.m. to 5 p.m. the following day. That is the 24-hour span in which the market operates on. And then, of course, we go from 5 p.m. to the next 5 p.m. to the next 5 p.m. until Friday 5 p.m. The market is closed for the weekend. And then, of course, we pick back up Sunday 5 p.m. All right, so we're going to start from here. This is the 5-minute time frame once again. And you can see inside this range of movement, we went from November 24th, 5 p.m. all the way to November 25th, 5 p.m. All right. Now, of course, getting back into this, we started from here. We made our way over here. We now see 1 day's worth of movement on the M5 time frame. Now, here's a key little fact. There are a total of 288 candles on the M5 time frame that incorporates 1 day's worth of movement. So if I'm on the M5 chart, that lets me know, once again, there are 288 candles on M5 that goes inside 1 daily candle. All right, now if we were to drop this down to a different correlation, let's go from M5 to M15. There are a total of 3 M15 candles. Now let's correlate M5 and M15. There are a total of 3 M5 candles within 1 M15 candle. Of course, 5, 10, 15. And then from there, there are a total of 6 M5 candles in 1 M30 candle. And then, of course, moving on from there, we have a total of 12 M5 candles inside 1 H1 candle. So the reason why I'm pointing this out is just to help you guys understand, once again, one time frame plays directly into the next. When I'm trading, when I'm looking at the markets and I see my time start to move, of course, going from 5 a.m. to 6 a.m., I know that, well, if I had a 5 a.m. to 6 a.m., that lets me know 1 hour has passed. And inside that 1 hour, I have a total of 12 M5 candles that will be visible for that hour. I have a total of 4 M15 candles that will be visible for that hour. And then, of course, I have a total of 2 M30 candles that will be visible inside that 1 hour candle. So think of it as looking at it as an X-ray, right? If I'm on the daily time frame, or rather if I'm on the M5 time frame and I'm looking at 1 day's worth of movement, well, the X-ray vision provided for me by M5 will show a total of 288 candles. If I am on the 1 hour time frame, I know that there are a total of 12 M5 candles in there. And if I'm on the M15 time frame, I know there are a total of 3 M5 candles in there. So now let's go up a time frame and continue doing the same thing. So here we are on the M15 time frame. On this particular time frame, inside that same yellow shaded area on M15 time frame, we actually have a total of 96 candles. All right, so it takes a total of 96 M15 candles to give us 1 day's worth of movement. All right, so once again, looking at it as a magnifying glass, like a X-ray vision, looking at a chart through the X-ray vision of the M15 time frame, right, we have a total of 96 candles. When it comes to a correlation closer in time, for example, the 30-minute chart, we have 2 M15 candles inside one 30-minute candle. We have 4 M15 candles inside one H1 candle. And then, of course, we have a total of 16 M15 candles inside one H4 candle. All right, so once again, if you understand your candlestick anatomy, your time frame anatomy, you'll learn to be able to see what the market is doing from one time frame to the next. And overall, it'll help you visualize and see both the long-term and the short-term moves that are coming into the market based off of what one time frame is saying in regards to the next time frame up from it. So going into the M30 time frame, and of course, getting back into our yellow square, we're going to see that inside this day's worth of movement, we have a total of 48 M30 candles. All right, 48 M30 candles go inside one daily candle. And of course, if we correlate that to our next time frame above it, the H1 time frame, you're going to see that we have 2 M30 candles inside of one H1 candle. Of course, moving on from there, we have a total of 8 M30 candles that fall into one H4 candle. And then, of course, like I said, a total of 48 M30 candles that makes its way into one daily candle. Continuing up the line, going up to our H1 time frame. When it comes to H1 time frame, we have a total of, right, you guessed it, 24 hours in a day. So that gives us a total of 24 H1 candles, 1 hour candles inside one daily candle. So as I went from time frame to time frame, you see how we were seeing less and less and less candlesticks. Of course, if I'm on the 1 hour time frame, I'm only going to see 24 when it comes to 1 day's worth of movement. And of course, I understand that I have a total of 4 H1 candles inside of one H4 candle. All right, so using that magnifying glass, 4 H1s goes into one H4 time frame candle. And then of course, now if I go up to my H4 time frame, I'm going to see that 6 candles gives me a total of 24 hours. 6 times 4, 24. And then from there, I know that I have only a total of 6 H4 candles inside my daily time frame. All right, and then of course, 1 day. So just from this very perspective, you guys can start to see now why it's important to be able to read and understand how one time frame speaks towards the next time frame. And then of course, now you're starting to understand why we only use daily and weekly as our structural time frames, H4 serving a slightly different purpose, even though it is part of our structural time frame, that being the smallest out of all 3. However, you can imagine if we were using H1 or M30 or M15, not even to mention M5 as part of our structural time frame, it will be very easy to get lost in the sauce as you have so much range of candles on the M5 time frame. It'll be very easy to say we are in an uptrend or in a downtrend if we were to try and apply those structure rules to these lesser minor time frames. That's why when it comes to structure, when it comes to understanding candlestick to candlestick, we know that only daily and weekly define our trend. H4 is part of our structural time frame. Anything else beneath does not get the rules that we use to apply structure. All right. Okay, so to properly demonstrate what I'm about to teach you, I want to first highlight a couple of things. Number one, whenever price is moving, all right, whenever price is moving, whether we're going to the upside or whether we're going to the downside, as price is forming its waves of movement, in this case, let's take a look at upwards movements. One of the key things that we can notice, and one of the key things for you guys to keep in mind, understand, is that once price is moving upwards and we're getting a high and a higher high, right, we only have one of three variations that can follow next. All right, so upon getting a high or getting a higher high, in this particular case, one of the three variations that we can see is going to be price pullback, giving us a equal high, or we can see price pullback, give us a higher high, or we can see price pullback and give us a lesser high. Now, the lesser high is the point. Now, the lesser high is what I want to focus on today. All right, so once again, just to recap, let's go ahead and put our magnetic tools on. All right, once price is giving me a high followed by a new high, only one of three things can occur. I can either get a pullback that leads into a higher high. I can either get a pullback that leads into a equal high, or I can get a pullback that's going to lead into a lesser high. And the lesser high is what leads to what's called a Quasimodo. So your Quasimodo is actually a structural reversal pattern. Now, most retail traders, they look at this particular movement and they classify it as a head and shoulders. However, the reason why I did not teach head and shoulders so far in this course is because I want you guys to understand the term Quasimodo. All right, so while it may look like a head and shoulders, one of the key differences between the two is that most retail traders, they look for price to create a high, then of course a higher high, and then when it comes to the head and shoulders pattern, they look for price to create a proper and equal symmetrical shoulder before rotating on down to the downside. However, one of the key important things to note is that there is not always symmetry in the markets. So whereas your head and shoulders is your typical retail trader reversal pattern, I want to introduce you guys to the term called Quasimodo. So your Quasimodo simply says, hey, after getting a high followed by a higher high, as long as I do not get a higher high from this point, or I do not get an equal high to create a double top, if I get any point that is lesser in height from this point here, there is a strong chance I will be getting a reversal pattern. All right, so your Quasimodos are actually structural patterns that banks use, that banks create to turn price around. All right, and so of course, to delve into this just a little bit deeper, your Quasimodo variation can quite simply look like this, with this being the lesser high from that high up here. It could be closer up like this, and then we get the reversal. It could even be perfect symmetrical, or once again coming back on down to a smaller range. Regardless of what size this is, as long as this is lesser in height in comparison to the high of the move, then there's a strong chance for getting a Quasimodo. Now, your Quasimodos can be seen on any time frame, whether it be daily, H4, H1. So let's go ahead and pick some out so you guys can get a better understanding of what I'm talking about. Okay, so I marked off a few areas on the chart with different color schemes to represent different time frames. So let's go ahead and just look at our Quasimodo variations in yellow for our daily time frame. So you can see we can have a low, a lower low from that low, followed by a lesser low. And then in this case, you see we had a retest of that lesser low point, producing a bullish movement, of course, giving us that Quasimodo reversal pattern. But now you can see if we were looking at this from a retail trader perspective, we did not have perfect symmetry in terms of candle bodies when it comes to identifying that neckline. All right. And that's because when it comes to the markets, there may not always be perfect symmetry in how the banks move and create structure. Therefore, when it comes to understanding these patterns, we go with the term Quasimodo just to simply help us know that as long as we have a low, a lower low from that previous that first low, and of course a lesser low from the second low, we will end up getting a Quasimodo reversal pattern, which we know is how the banks like to reverse prices. So here is another one as a good example. We have a low followed by a lower low followed by a lesser low, and of course, what do we see? A reversal. All right, moving on over to our next shaded area in yellow. Once again, you can see we have different variations of this, but however, the same thing applies. We can have a low followed by a lower low, all right? And so, of course, we were in a downtrend. We were expecting price to give us a new lower low after pulling back on up. In this case, you can see it printed for us a lesser low from this low point here. And then from there, we had a reversal in price. All right, so those are your Quasimodo variations. Those are how you can understand it. In this case, we're viewing it from a downtrend perspective on the daily time frame. Let's go ahead and take a look at a couple of more examples of Quasimodos on our H4 time frame. Okay, so on our H4 time frame, once again, you can see the scenario that looks more like what retail traders like to see, the perfect neckline. In this case, however, we know quite simply, we can have a high, a higher high, followed by a lesser high, meaning once again, we fail to produce a new high above our last high point. And then from there, we get a reversal pattern. Notice how we come back up to retest that right shoulder of the Quasimodo before ultimately returning back down. All right, so let's go ahead and take a look at a couple more. Inside this area up top, you can see we've had a high, a higher point higher than that, followed by a return to give us a lesser high, and then of course leading out into a reversal. Now in the same red square to the bottom, notice how we've had a low, we've had a lower low from that point there, and then from there we've had a slightly lesser low, which then of course lead into that reversal. So in this case, you can see how we set ourselves up for the Quasimodo to the upside. We then use the Quasimodo to the downside to return to push us on up to get the right final shoulder for this bearish Quasimodo. Of course, bearish meaning because we push price down, and of course, bullish Quasimodo meaning we reverse price to the upside. So let's go ahead and take a look at one more example on the H4 time frame. Once again, when it comes to Quasimodos, quite simply, we have that high, we have that higher high point, followed by a lesser high point that then leads to a reverse in price direction. So whereas retail traders typically like to see perfect symmetry, we now know that with the way that banks move and push prices on a day-to-day basis, there may not always be symmetry involved. And so of course, we want to see a new lower low. We want to see a continuation to the next low after every time the market prints a new low. And of course, failure to do so lets us know that if we get a low followed by a lower low and then a lesser low, that is a strong possibility of a Quasimodo pattern. Of course, now same thing applies to the upside. If we get a high and of course we get a new high beyond that, but fail to get a next high upward, that lets us know we are getting a Quasimodo reversal pattern. And then of course that will cause price to decline. All right, so once again, these are your structural reversal patterns. All right, we want to do away with the term head and shoulders. We want to actually pick up the term Quasimodo because we understand what that actually means when it comes to reading price correctly based off how banks push prices on a day-to-day basis. And so now to wrap this video up, in your text lesson below, once again, I will have written out these very simple rules, this very simple way of looking at price. Remember, if you're moving up, only one of three things can happen after printing a new high. Failure to get a new higher high or failure to get a new lower low lets you know that you're only going to get a lesser high, which will produce a Quasimodo, of course giving you that reversal pattern, or you will print a double top or double bottom, which we also know is a reversal pattern. All right, so jumping right in, let's go ahead and take a look at some continuation patterns. In your text lesson below, you can see a picture of all the particular patterns that can be picked out on the charts when it comes to continuations and when it comes to reversals. However, here on the screen, I'm just going to highlight a couple that I found for you guys just for the sake of your education and learning. All right, so starting from our very left, let's go ahead and zoom in. We have a nice rotating bullish channel, and with this particular continuation pattern, the market simply likes to trade sideways, however, in a direction. All right, so when it comes to these rotating bullish channels, we typically do see an explosion out of the channel once price has completed its rotations inside of it. And this, once again, is a rotating bullish channel that leads to continued bullish movement. All right, so moving on, let's go ahead and take a look at another one. Here we have the bullish channel. So the bullish channel, similar to the rotating bullish channel, right? This one, we actually just push up, and then from there, we actually trade sideways. So that sideways movement is typically followed by a continuation of bullish activity, right? And of course, the main differentiating difference between this bullish channel and the previous one is whereas the previous one was rotating upwards at an angle, this one we're just rotating going side to side. All right, taking a look at our next continuation pattern, we have the bearish flag. So the bearish flag can typically be viewed by a nice bearish drop. Then from there, we rotate backwards, going higher and higher, giving us a nice little pullback. And then from there, we break through the bottom of the flag and continue melting south. So once again, this is a continuation pattern that typically leads to more bearish movement. Let's go ahead and move on and take a look at another one. Here we have the bullish triangle. So the bullish triangle is typically observed by price rotating up and down as it funnels its way into the edge of the triangle, all right into the apex of it. And then from there, typically you'll see price explode to the upside and continue that upwards movement. Moving on with our demonstration, we have another pattern called the bearish rising wedge. So the bearish rising wedge, once again, is typically found by a drop. From there, we rotate backwards. You may even see a series of higher highs and higher lows, or what can be viewed as that. And then from there, we have a melt and a continuation of bearish direction out of the channel. All right. Taking a look at our next continuation pattern, we have the bullish falling wedge. So once again, you can see price funneling itself downwards, back and forth, rotating inside of the wedge. And then from there, the bullish wedge is typically ended with a huge switch in direction, a nice bullish breakout to the upside, and price goes up and away. All right, so last but not least, I just have two more for you guys. Once again, the bearish channel, drop, sideways movement, and then we continue rotating on to the downside. And moving on to our right, we have the bullish rotating channel. Once again, we push up, we rotate back and forth with bullish direction, and then finally we explode upwards and continue moving. All right, so this is just a few examples of the continuation patterns. You can find a couple more in your text lesson below. And of course, from there, understand how you can use them when it comes to trading. Now, me personally, like I said in the beginning of this video, I don't really look for them too heavily. However, for the sake of your education on Forex, I did want to go ahead and make mention of them and teach it to you guys. Okay, so in this video, we're going to speak on the topic of price action basics. All right, so price action, once again, is the very fundamentals of the way we trade here in CFX University. And this video just serves as a brief introduction to how to understand it and view it correctly. Let's go ahead and get started. Okay, so continuing on with the CFX University education, right, we're going to make a quick video on trend lines. All right, so when it comes to drawing trend lines, I typically like to draw them in one or two very specific ways, and I also like to manage my trend lines in one or two specific ways. So first, taking a swing high point from the very top of the wick where we had the highest level of trading activity for that day, I want to connect my trend line to a next swing high point. All right, from there, I let the trend line extend into the future. And after extending to the future, I'm looking for rejections off of my trend line to help me potentially catch trades as I factor in other things like structure, supply, and demand into my analysis. Now, as price interacts with your trend line, you will, in a lot of cases, have need to edit it. So when I say edit, or as we connected 1 and 2 points, because price was able to trade and close above the trend line, also just very slightly, I would want to extend my trend line out to catching the next point. All right, so whereas we previously used this one, we now went to this swing high, the highest point of the two, and we let it run into the future. And then from there, you can see that when we did make our way back on up, we were able to touch that trend line just perfectly. All right, so moving further down towards current price action, you can see that trend line that was drawn using that point. Initially, we connected this trading high, swing high point here. However, because we were able to get a little bit beyond it, we connected with this point here. We're able to have a perfect touch. We're able to again have another perfect touch to help us catch trades, right? Factoring into our analysis that we would have primarily been looking for sells. And then of course, price turned around and moved south. So that's how we draw trend lines, right? This is how we edit them based off what price is currently doing. And the same thing can be applied to a bullish perspective. So if I take this previous swing low, all right, and let's say I connected this point initially. In fact, let's just make sure we're editing correctly. Swing low. And let's bring it in to connect that first touch. And let's go ahead and make this line blue. You can see that we would have had one interaction to get us a second point. Our third interaction would have given us a good example of a trade. You can see we had more interactions going into the future that price was able to reject and sustain the trend line before giving us this impulse up. And then from there, you can see that we end up breaking that trend line. We attempt to come back on a retest in the opposite side. However, because the trend line is broken, we know that this 1, 2, 3, 4, 5 perfect touch of a trend line is no longer a valid line we would use. All right, so similar to supply and demand, once your trend lines get broken, you will need to delete them, right, and redraw them. So in this case, I'm going to connect my swing low to my first interaction point that was given. And then from there, I can see a perfect rejection. I can see extending into the future. I had another perfect touch, all right? I had a very close touch. I had 1, 2, 3 touches here. And then last but not least, a break, a retest on the opposite side before price kept on pushing down. So this is how we draw trend lines. This is how we use them when it comes to our market analysis. All right. Once again, trend lines will not be the determining factor for trades. However, they do provide a level of confluence for us in the market to understand what price may potentially be doing in the future after getting that level of interaction. So you can see here I connected to one point with this point. We didn't get a touch, although we came close. Price was able to break through this area, letting us know that this trend line didn't really serve much of a purpose in terms of getting a proper bounce and continuation off. So this actually is a perfect opportunity to display the fact that trend lines can never only be our main source of trading. However, they do provide a level of confluence, right? Another market tool we can potentially use when analyzing as we look for trades from a higher time frame picture, and of course, executing those trades from the lower time frame charts. Okay, so jumping into today's video, let's talk about all the currency correlations out there, all the ones that I am personally aware of, and of course the importance towards using it, and of course the importance towards throwing it down when it's no longer applicable. All right, so starting first off with AUD, AUD pairs typically correlate and move together day by day in the same direction. All right. So while currency correlation is something that can be used almost like a cheat code to help you trade multiple pairs, one of the things you always want to remember is that currency correlation can shift. So your currency correlation is a direct reflection on the economical events going on in that particular country. So in this particular case, we're working with Australian dollar versus the US dollar, and therefore with the rest of the currency pairs that are in this list of correlations, the main key factor is going to be Australian dollar. So if we take a look at it, AUD USD can be seen going bearish, and we can see that turning point started around the 4th of November, and then of course now we are all the way down here. Now if I go to AUD CAD and I find the 4th of November, you're going to see the same thing. We have been going bearish, with the 4th of November being the main turning point in which AUD CAD started to go bearish, similar to AUD USD. All right, let's take a look at AUD JPY. So you can see here we are, November 4th. While we did get a bearish candle, it was actually 1, 2, 3, 4 days later that AUD JPY caught along with AUD USD and AUD CAD and started going bearish. So like I said, while currency correlation does have its usage, its value, we cannot just blindly sell on all pairs that are AUD just because we see one going bearish, we see one going down or up. In this case, we have to always trade structure relative, trade price action relative to how it's formed on that particular time frame. However, we can use currency correlation as a little cheat code, as a little extra guidance to what one pair might be doing in relation to the next. So let's go ahead and take a look at AUD CHF. Once again, if we find the 4th of November, this particular candle here, you can see that we ended up pushing higher, and similar to AUD JPY, it was on the 8th that we started our big bearish push, whereas on AUD CAD and AUD USD, this was the main bearish candle that we can see that led into our bearish decline. Now let's take a look at AUD NZD and have a look. Once again, with this being the 4th of November, you can see that we actually went up much higher, and it was on the 11th of November. AUD NZD started its bearish decline, following along with its other cousins in this family of AUDs. So once again, when it comes to correlation, just keep in mind it is a little bit of a cheat code. If we see one set of AUD pairs starting to decline, we know that at some point in the future the rest will follow. However, it is still going to be up to us using due diligence trading the currency pair that we're currently focusing on based off what price action is telling us, and not just only on what currency correlation is telling us. All right, so of course, if we go into it, our NZD pairs, they have similar correlation. All right, when one is going up, typically the other one is following suit. However, once again, remember, just because they're following suit doesn't mean they're going to have the same layout of candles, the same movement on a day-to-day basis. That's why it's going to be up to us to remain diligent and plot our structure or use our price action analysis skills to trade objectively, even if we know NZDs are all trending upward based off of our currency correlation. All right, so now let's take a look at some others. We have the GBP correlation. Now, when it comes to GBPs, once again, GBPs have similar correlation like what we saw with AUD and NZD. However, one key important thing to note, your correlation, they can shift at any point in time. So while we can use them for extra confluence, we got to keep in mind that, hey, on a day-to-day basis, just because we see one group or one family of currency pairs moving upwards, it doesn't just mean we can blindly sell or buy at random. So taking a deeper look at GBPs, we can see that GBP USD, right? We had a nice bullish push. We had a run coming from the 13th, rather the 12th of August, that pushed us up to the 23rd of August. And so if I find that same particular time frame, once again, 13th and 12th of August into the 23rd, we can see we're getting mirrored bullish movements on GBP USD, GBP JPY, of course, finding the same thing. You can see that on the 12th, 13th of August, we were getting mirrored bullish movements on GBP AUD as well. All right, 12th of August, mirrored bullish movements on GBP NZD as well. And of course, last but not least, on GBP CAD, 12th, 13th of August, we were getting mirrored bullish movement, right? So once again, currency correlation definitely is quite a bit of a cheat code. However, keep in mind your candlesticks, your time frames will show different pictures depending on what pair you're on. And so while currency correlation right now on GBPs are very strong, the family GBPs all going bullish, at some point in time, you can definitely expect to see a shift. And then from there, GBP USD and GBP JPY can potentially do their own thing. And GBP AUD and GBP NZD can actually do their own thing as well and go opposite of those two. Now let's take a look at some of our inverse correlation pairs. All right, so starting off with our dollar inverse correlation, typically what you can see in the markets is that DXY, right, the US dollar currency index, will move opposite of these pairs. Now, as far as currency correlation goes, Euro USD is the strongest correlating pair with the US dollar, meaning Euro USD will go candle for candle completely opposite of what the DXY is doing. However, your AUD USD, your NZD USD, and last but not least, your GBP USD, they don't move as strongly in correlation to the US dollar, although they do have some correlating movements. Okay, so if I start off with my daily time frame here on the DXY, I'm going to see that I had a nice bullish push up, followed by a rejection, followed by a retest of that level of resistance, potentially giving me now a double top scenario, and of course a huge rejection. All right, so if I go to Euro USD, I'm going to see the same. I'm going to see that same double top scenario, and then from there I'm going to see that rejection here for this double bottom scenario, matching this double top scenario. All right, so once again, these two are inverse correlated pairs. They mirror each other to the exact T. However, some of your other currency pairs don't do the same, despite having some level of currency correlation. So on AUD USD, you can see that we have been falling over these past couple of days, while the DXY was rising those past couple of days. We can see NZD was actually pushing up these past couple of days, while the DXY was pushing up these past couple of days. So whereas typically NZD USD would move opposite of the DXY, we can see at this particular moment, they're not sharing that inverse correlation in which we typically expect. Why? Like I said, depending on the economic climate, depending on the events that are factoring into that country's particular economy, we can see a shift in correlation. So we just have to keep that in mind when we're trading and when we're wanting to use correlation from one currency pair to the next as an extra added layer of confluence for our market bias or market decisions. So of course, moving on to GBP USD, you can see we were pushing upwards the past couple of days. We do have that Quasimodo variation. And of course, the DXY, no Quasimodo variation in sight. And you can see it doesn't exactly correlate 100% when it comes to the movement. So once again, keep in mind, things can shift. When they shift, you got to shift with it, right? Trading is always going to be a game of mental agility, making the best informed decisions based off what price is telling you with all the factors that you can incorporate before you make your decision. Now let's get into another inverse correlation list. All right, now this one is one of my favorites because I do trade mostly GBPs. So when it comes to GBP AUD and AUD USD, a lot of times what you can find is price moving opposite of each other. Once again, an inverse correlation. So in this case, you can see I have this nice bullish movement coming in on GBP AUD and on GBP AUD. And on AUD USD, you can see I have a nice bearish movement giving me the opposite. All right, bullish movement continuing in from the 8th of November, going into the 29th of November. And of course, if I go to AUD USD, you can see the 8th of November giving me the opposite, that bearish move. Whereas on GBP AUD, I got a bullish move on the 8th of November. So the last one I'm going to gently make note of is USD CAD and US oil. Now, while not always reliable, in some cases you can see USD CAD pushing bullish while US oil is pushing bearish. All right, so let's go ahead and see if we can find the exact dates and let's see if we had any correlation. So this is a bullish move that started around the 28th, 29th of October, and of course going into the 20th of November. So on US oil, let's see what we see here. On the 28th of October, we can see we had a bearish push that lasted only a total of about 3-4 days. So in this case, you see we did have some currency correlation. However, currency correlation did not maintain itself as we saw price continuing to go bullish on US oil and price continuing to go bullish on USD CAD as well. All right, so once again, just a quick breakdown of some of the currency correlations that I'm aware of that I know that can be used when it comes to extra analysis, extra confluence. But please just keep in mind, correlations can shift due to economic events. These economic events happen on a day-to-day, week-to-week, month-to-month basis. So while you may be relying on it and it's proven to be successful for you 1 week or even 2 weeks or even an entire month of trading, do keep in mind things can shift the following month or the following week. And then from there, we're going to always have to make sure that we're aware of that shift. That way, we're not relying on a correlation that is no longer present. Now, the last set of inverse correlations I'm going to mention is going to be gold, along with the US 30 and the US 500, also known as the Dow Jones US 30, and also known as the Fortune 500, or in this case, XPX 500. All right, so these two, or rather I should say these three, have an inverse correlation with the US 30 and the US 500 moving opposite of gold. Now, the reason why these in particular have an inverse correlation is because from a fundamentalist perspective, when it comes to investing, most people typically either invest in stocks, and of course stocks that are prevalent in either US 500 or the Dow Jones, or if stocks are underperforming, the US 30 or the SPX 500 are taking a hit in the markets, people like to invest in gold. So if I take a look at some movements, you can see that I have been moving downward steadily on gold, and on US 30, I have been moving upward steadily. On US 500, I've been moving upward steadily, opposite of gold moving down steadily. So let's go for an H4 time frame. Let's take a look at some movements. All right, let's see if we can see any direct correlation in terms of price movement. So the 1st of November, we saw a nice decline in price. Let us pull up US 30 and go to the 1st of November. Right here. And of course, we see that opposite movement, a nice upwards rise in price. Now, let's take a look at the US 500. So let's find the 1st of November. And summarily, similar to US 30, we see a nice increase in price. All right. Once again, gold being that inverse correlation. So we have the 6th of November, giving us another continuation of bearish movements. Now let's take a look at the US 500 and see if we see the same. So the 6th of November, nice bullish movement. US 30, find the 6th of November, and we're going to see a nice bullish movement. So once again, you can see here with just these two examples that I've laid out, we do have some currency correlation between these two, inverse correlation, and in a lot of cases, it is exact movement for movement, day for day, opposite direction in price. So this just gives you a nice added edge towards your market bias, your market direction, your technical analysis for US 30 if you're trading it, US 500 if you're trading it, or gold if you're trading it, just to help you correlate and trade those particular movements better on a day-to-day basis. Now, once your skill set has grown, you will be able to trade all three of these in some cases at the same time, or maybe trade GA and AU since they're inverse pairs, and then of course swing AU to the downside because you know GA is going up, and of course swing AU to the upside because you know AU is going down, and they share that inverse correlation. So continuing our education on the Forex markets, let's take a look at two simple techniques we must always keep in mind. Number one, we always have to remember to look left. All right, so when I say remember to look left, quite simply, depending on where you are in the chart as live price is forming, you may not be able to see anything to your left. And so while we do see price trending downwards, right, when we're trading on a day-to-day basis, we always want to make sure we are not selling into any previous levels of support. And in all cases, we need to make sure we know what price did last time it was there. So in this particular case, you can see that, well, as I'm moving downwards, I can't really see any support levels. Therefore, I need to always make sure I zoom out and identify any relative support levels we may be coming to as price is moving downwards. Now, you don't have to draw a bunch of lines, a bunch of horizontal lines all over the place. Quite simply, as price is forming, we just want to make sure that we are aware of what it did last time it was there. That way we can potentially anticipate a new level of interaction off that same level or near it. So in this case, you see as we were flowing down, looking left, we will identify this level of support. The minute price was able to break beyond it and continue pushing down, we will simply have made sure we zoomed out and looked left to identify the next relative level of support that price can fall to. That way, if we're selling, we wouldn't unintentionally sell into any previous levels of daily support. And of course, yet again, as price is continuing to break through a new level, we just want to always make sure that we zoom out and highlight any potential support levels price may be falling to. That way we don't buy or sell unintentionally into known levels of previous support. So you can see when we're focusing on this particular area, and of course if price was developing live, right, with the two levels of support highlighted, this one being the relevant one, we would have known that based off where we are currently in the market, we have a level of support beneath us because we zoomed out and looked left to identify what price did last time it was near this area. And now that we're focusing on our price action, and of course we see the price develop over day to day, we would have been expecting and of course aware of this level of support and its potential to cause price to rally and push back on up after this bearish move. So looking left, guys, is just once again a very simplistic concept. If I was to move over to my current price action, the same thing would apply. If I'm going to look left, I need to make sure I understand, hey, are there any previous levels of resistance, or in this case, any previous broken levels of support that can become a resistance upon rejecting and then coming off of it, that price can possibly hit once I'm pushing up. So in this case, looking left would have helped me identify this broken level of support, and looking left would have helped me identify this confirmed level of resistance that caused a turn in the market as a potential level price could hit and reject as it was making its way on up. So in this case, we retested broken support on our daily time frame and then turn around, and you can see we are currently having a decline in price coming back down to previous levels of support and demand. All right, so let's get into our next quick market technique. This one is going to be empty space. Now, when it comes to empty space, there are two particular types that we need to highlight and identify and just quite simply make note of. All right, so the first one when it comes to empty space is going to be the empty space that can be visible between a lower high point, a impulse level, or even just a support level, resistance, etc., right? That price leaves as it's making its way down in a trend. So when I say empty space, you can see that from this point here to this pullback point here, we had some empty space, right? There was no candlesticks that can be visible in it towards our right. And then from there, you can see this bullish push, this upwards movement here, helped us fill the empty space that was left in between the start of this impulse move to the downside and of course this pullback move here. Now, with the empty space always needing to be filled, it's not a matter of if price will do it, it's just a matter of when price will do it. You can see that the first initial push filled some of our empty space, and then from there we knew we still had this area as a range of empty space that needed to be filled. And from there, of course, you can see that's exactly what price did. We came back on up, filled this empty space, meaning that we have candlesticks that are inside this range of price, of course now filling that range. However, empty space is everywhere. Price always leaves empty space as it makes itself from one move to the next. So in this particular case, if I was to move over to my right, you can see that upon this development, and in fact, let's go ahead and use our replay feature. Okay, so another thing to keep in mind is price will always fill that empty space. Like I said, it's not a matter of if, only a matter of when. And breakout candles that produce continuations of our trend or just strong bearish movements are also good examples of empty space that price will do its best to fill. Now from here, you can see that from here to here was a range of empty space, meaning we had no candlesticks that are now coming back up into the upside of this range of price from this peak here down to where we have this level of resistance. We also had this level of resistance down here as a range of empty space. Now, if we go ahead and we use our replay feature to demonstrate this, you can see that price made its way back on up and refilled this range of empty space. All right, once again, if I look to my right of my set of breakout candles, I know that price will fill that range at some point in the future. All right, same thing can be said of this move that we have here. Between this level of support that I'm highlighting and of course this level of support down here, we also had some empty space that price turned around and filled. So you can think of empty space as the snake game that we used to play on the old Nokia phones, right? Almost like price going up and down inside of a square, doing its best not to hit on each other, but filling that empty space as we go. All right, empty space, once again, goes from impulse moves to impulse moves. So in this case, we had an impulse to the downside and we filled that empty space in between, filled the empty space in between here as well. And then of course we can have price filling empty space when it comes to retracement legs or continuation legs, which we'll get into shortly. All right, so in this particular case, you can see that we had empty space from here to here, from the support coming on down. And when price turned around and went back bullish, we filled this range of price to the upside. All right, same thing applies once again with this range of movements. Once again, think of it like the snake game. You had a level of support and you had empty space as price was making its way upwards. Once again, just to use the replay feature to demonstrate it. All right, we have all these we have all these bullish candles from this level of support. And so I know that when price does come back on down, we're going to need to fill the empty space that was left in the process. All right, now if I go ahead and press play, you can see we end up coming back on down, filling that empty space that was left between this level of support and of course this area of support here. All right, if I go ahead and press pause, you'll see that we now have some empty space that hasn't been filled from this area of support to this area of support. All right, so we know that this is empty space to be filled if price continues moving downwards. And we know that this is going to be empty space to be filled between this area of resistance and that area of resistance if price makes its way back on up. So let's go ahead and just press play and let's see what happens. Well, you can see price ends up filling the empty space between this area of support and that area of support. We now had another area of empty space between this area of support and the one beneath it. And of course, this huge bearish movement ended up filling that empty space to the T. So once again, think of it as price closing the gaps, filling the gaps, the empty space that can be seen on your charts as structure, as your impulse moves, as your continuations, or your retracement legs of structure develop.